Good morning, everyone. Thank you for joining us this morning. My name is Jennifer, and I am the Director of Marketing here at Williams Keepers. We are thrilled to have you guys all on the line with us today as we kind of go through this PPP loan and kind of unmask how to get the most forgiveness out of that loan. So with us today, we have Jeremy Morris, who is a member at Williams Keepers, as well as Mark Gingrich, who is also a member at Williams Keepers. If any of you joined us for our webinar last month, where they gave kind of additional information about the PPP loan as well, you will be familiar with these guys. They are fantastic. They will do a great job of answering all of your questions today. We do have everyone muted. We're expecting a couple hundred people on the call today. So we have everyone muted for now. So we'll ask that you use the question and answer feature within Zoom, and the guys will make sure to work through all of those questions. They'll probably stop intermittently throughout and then also take questions after the webinar is over as well. So like I mentioned, if you do have a question that you feel like you would answer better or ask better live, go ahead and submit that request through the Q&A and I can unmute you individually as well. But we'll work on keeping everybody muted just so that we can kind of minimize the background noise and everything. So again, I will welcome everybody to join us today. We will make this available on our website. Both the slides and the recording will be available on our website at williamskeepers.com. We have a COVID-19 resource center, and under there will be webinar resources, and you'll find this one there as well as the one that they did in April. So I'll go ahead without any further ado, and I will let Jeremy and Mark get us started.
Yeah, thank you, Jennifer. Happy to have everyone here today. Again, it looks like we're pushing almost 300 attendees. So again, very happy to have you guys here for something that obviously has a lot of interest to business owners. As Jennifer said, this is kind of it's a follow-up to a webinar we gave, gosh, it feels like 20 years ago now, sort of at the outset of this whole COVID mess, as well as the CARES Act and the PPP. We've been releasing a lot of information on this, and Mark Gingrich, who's with me today, has a really nice white paper that we published on April 13th of this year that talked about how to maximize PPP forgiveness, or how to maximize the use of those funds. And so we're kind of picking up from there. The only issue is on April 13th, we didn't have a lot of information. We had the framework, but there were a lot of details that we didn't have answers for. So in the intervening time, we've received those. We've received guidance all the way up through this weekend. They released the last piece of guidance over the Memorial Day holiday weekend of all times. And they've also recently released the forgiveness application. So we're going to start with that framework and then fill in a lot of those details that we didn't have at the time. The other thing I would mention is, since I mentioned the forgiveness application, you'll notice we will not be going through the forgiveness application, the nuts and bolts of how to fill out specific line items. But the way this presentation is set up in these steps mirrors how the calculation will be computed and done on the application. So again, we're discussing this conceptually, but it's going to mirror how the calculations will work on the how it will work on the application. So with that, we're going to start with step number 1 before anything else happens. Okay. The only way we're going to get forgiveness of these PPP funds if we spend them on what we have called from the beginning good cost. In other words, whenever you took out a PPP loan, there were limitations on both what you could spend it on, okay, what were eligible expenses, and accordingly, forgiveness is only available to you if you spend them on certain eligible expenses or types of expenditures. We've broken these up into 2 different categories: payroll and non-payroll good cost. You'll notice right off the bat that we've put a 75% indication on the payroll cost. And let me stop just for a second here. This is one of those areas where I think it's probably been one of the most misunderstood aspects of this. I think every time you get into the popular press, they talk about the PPP loan and they talk about the forgiveness that's available to you if you spend at least 75% of it on payroll costs. And there is a limitation associated with that. This was not in the CARES Act, but it was in in later guidance where they said the expectation is you will spend 75% of the forgivable cost on payroll. here's what they mean by that. If it's a haircut, and Mark will get into that calculation later, but if you don't meet that requirement, do not worry. It's not a cliff. Failure to meet the 75% payroll limitation does not mean none of your expenses are forgivable. It just means there is a little bit of additional limitation on what's available for forgiveness. In other words, think of that 75% limitation as a haircut, not a guillotine. Okay, it's going to reduce forgiveness, but it's not going to cut you off from forgiveness completely. But the expectation is, and that for most businesses, that's likely where most of the expenses are going to be. So as it relates to payroll, the definition in the Act, it starts off with any compensation with respect to U.S. employees. So what do we mean by compensation? So when we talk about employee compensation, we start with gross compensation, and we'll define that here in a second. Think of just your normal salaries and wages that an individual makes. This, however, is capped at $15,385 per person. And I think this is maybe the initial question we got about, do we prorate our employees who gross $100,000 or more annually? Yeah, if this is, I think this may be what we're getting at with that. But if gross compensation for any individual is $100,000 or more than $100,000 annualized, you only get to count up to $100,000. $15,385 happens to be 8 weeks of $100,000. If you take $100,000 divided by 52 weeks, multiply by 8, that's where we're getting the $15,385. So as it relates to gross compensation for anybody that ends up on your forgiveness application, that number can never exceed $15,385, no matter what you pay that employee during the period. Okay. Employer paid. Now, in addition to that, so you've got compensation limited to the $15,385 for the 8 weeks. In addition to that, with one exception, you get total amounts paid for employer paid benefits, specifically health insurance and retirement benefits on behalf of your employees. That also counts as compensation. Those are not subject to the $15,000 limitation. In addition, you get employer paid state and local taxes assessed on the employee comp. That's unemployment insurance tax. That's not employee withholding. That's not employer portion of payroll taxes. Again, the employee portion of payroll taxes and withholding is included in gross wages. So we're fine with that, but we don't get to add that on top of it. In addition, we don't get to add employer payroll taxes on top of compensation. Okay, so gross comp max at the $15,000 plus the amount paid for health insurance and retirement, plus state and local taxes assessed on employee comp. Think unemployment insurance. Now, I said there's one exception. If you have an S corporation or a C corporation, the owners can be employees, and if they work in the business, they're drawing W-2s. They're subject to these limitations, but they're also subject to an additional limitation. That limitation is this: if you have an owner employee, their owner compensation for purposes of forgiveness cannot exceed 8 weeks worth of 2019 compensation. What they want is, they don't want businesses meeting the forgiveness requirement by increasing owner compensation. That's not what they want to do. So not only are owners subject to the $15,000 limitation, but if they made less than $100,000 the year prior, that amount that they made in 2019, 8 weeks worth of it is a limitation. Okay. Same thing with retirement and health insurance. If you have retirement and health paid on behalf of employee owners in an S corp or a C corporation, the amount you claim for forgiveness cannot exceed the amount paid on their behalf in 2019. So they don't allow you to increase owner compensation or benefits in 2020 during the 8 weeks in order to meet the forgiveness requirement. So that's for employee compensation. As we look at gross compensation, that includes almost everything: gross salaries, wages, tips, commissions. If you let someone go in the meantime and pay them some severance or dismissal or separation payment, that counts. Okay. In addition, most paid leave counts, and the reason we say most is because if you may remember, we've done some presentations and discussions and materials on Families First Coronavirus Payroll Act. Okay. Under that Families First Act, businesses can receive tax credits that compensate them for providing leave for their employees. Okay. if you are paying leave to your employees and that leave is being reimbursed to your business through the Families First Act, they are not going to allow you to also claim forgiveness on those same wages. Okay, because you're basically not paying them, you're being reimbursed for them. So in that case, you're able to, you get the compensation, you get the reimbursement via the Families First Act, via the payroll tax credit, but you do not get forgiveness. So that in a nutshell is the compensation that counts. Okay. The other big question that we've been getting is what payroll to include. And so for that, I'm going to kick it over to Mark to discuss the issues related to what payroll periods we look at and what cost, this whole paid and incurred concept, what cost actually count within that 8 weeks.
Thanks, Jeremy. You set it up very nicely, and we'll try to knock them down. So Jeremy covered a lot of the material that we knew coming out of early guidance on the PPP program. And we got a lot of questions from folks on, well, how are we measuring this? What counts? What doesn't count? And Jeremy covered several of those categories that count or don't count, but what about the time periods in terms of what counts or what doesn't count? So throughout our presentation, you'll see 56 days and 8 weeks used interchangeably. The first day of the 56-day or 8-week period is the day that the loan proceeds landed in your business's bank account. Because of the confused rollout of the program, for some businesses, there were multiple deposits made into their bank accounts of PPP funds, and we would go back to the earliest date that funds hit your bank account is the start of our 8-week or 56-day period that we're going to count up all of these expenses we're paying. And here we're going to focus on the payroll costs. So our general rule that every business can apply is we're going to look at the day that we got the money, the next 55 days after that, and we're going to look at amounts paid subject to the $100,000 annualized or $15,000 and change cap on above $100,000 a year employees. We're then going to stop and answer the question, well, what if my pay period crosses over the expiration of that 8-week or 56-day period? Do I need to have a special payroll at the very end of my 8-week period to make sure that I get all of the payroll costs that were accrued but unpaid at the end of the 8-week period to count? And the favorable answer we got a couple of weeks ago, reaffirmed in the guidance that came out last Friday, is no, we don't need to mess with special payroll runs for normal, ordinary course payroll. We can instead rely on amounts incurred at the end of that period as long as they are paid on the next normal payroll date. Okay, so that's our general rule. Our general rule is that it's a mixture of paid and incurred. We'll count everything that's actually paid, and then on the tail end, we'll pick up the things that are incurred but unpaid at the end of the 8-week period, but then subsequently paid on our next normal payroll date. Let me pause here for a second. Jen, if we could go back just one slide before I advance it. We have a special rule for businesses that have payroll at least as frequently as biweekly. And so the special rule deals with a concern that the AICPA and others had raised of, man, this counting and cutoff stuff gets complicated. Can we just make it simple? And so the simplification is, it doesn't work if you're running, a monthly payroll, for example. But what you can do is, for administrative convenience, we can just start with the first pay period after the funds are deposited. And instead of starting our 56-day clock on the date that the funds hit our bank account, we'll start it to run concurrent with our normal payroll cycles. And that way we can just count payroll 1, payroll 2, payroll 3, payroll 4. If we have 8 payrolls in the period, go through 8, and then we'll pick up whatever accrued or unpaid wages there are at the end of that period. And we'll get the 8 payrolls. If on my weekly payroll example, we'll get the 8 payrolls occurring within our 8-week period. And we'll also pick up any accrued but unpaid payroll at the very end, so that we'll actually get a little bit more to reflect the fact that most employers have a lag between their pay period and the pay date. Okay, so now we can go on to the next slide, Jennifer. Thank you. And so we have some relatively simplistic answers to these questions, but just for completeness, we'll work our way through them. So wages are considered paid when, if you issue manual checks, the paychecks are distributed to the employees, or if you pay electronically the date the business originates the ACH transaction. That's as specific as Treasury got. When payroll is processed through a clearing account, I think there's support based on the guidance we have today that it's the earliest date where the funds leave the business and go into the payroll clearing account, and not the actual date that they get ACH'd out to the employees. But there is some ambiguity there on that question. We go to the next slide. Wages are incurred. So remember, we're picking up amounts incurred but unpaid at the end of our 8-week period. Or if we elect the alternative period, we have the same issue where there are incurred but unpaid wages at the end. And so those wages are incurred on the date that the employee's pay is earned. So we're going to look at a concept of when they did the work for which they're being paid, and attribute those wages back to that calendar day. All right, let me kick it back over to Jeremy to deal with a specific situation we have on self-employment income. The materials we've covered to this point have dealt with W-2 wage earners.
Yeah, thank you. And I believe this is also a question that was asked as well. So as we've talked about payroll costs, we've kind of put this at the end. It really does get included as part of that, but it was a little bit of a special thing. And this is something that caused quite a bit of confusion. So we've saved it for the end. So in addition, they mentioned in the bill, payments to independent contractors and individuals that are self-employed, and that caused a lot of confusion because they didn't really mean as part of salary costs, salaries and wages, they did not mean you get to include payments to independent contractors. Based on the guidance we've received subsequent, what they meant was payments received by owners, those individuals that are self-employed. So they had self-employment income either on their Schedule C, or maybe they were a farmer that had self-employment income on a Schedule F, or they were general partners in a partnership who had partnership income subject to self-employment tax. This income counts. It counted both for purposes of the loan, and it also counts for purposes of forgiveness. Having said that, it's generally based on 2019. So we talked about it being capped, just like owner wages are capped, owner W-2 income is capped at 8 weeks worth of 2019 income. This forgiveness, as it relates to self-employment income, is also capped at and calculated on based upon 8 weeks of 2019 self-employment income. So if you had a Schedule C individual, if you could go back just 1 second, Jen, sorry. If you had a Schedule C individual and they had, let's say, $80,000 worth of self-employment income in 2019 on their Schedule C, their loan amount was based upon 2.5 months of that 80,000. I think that's the amount. Let's assume 80,000. It was based upon 2.5 months of that 80,000. Their forgiveness is going to be based upon 8 weeks. So 8 divided by 52 times the $80,000 worth of 2019 self-employment income. It is a mechanical calculation, and there's always going to be a gap. But if you have employees or rent or interest in your business, some of that loan amount can be used to offset those other costs, subject to the 25% limitation. As with all other compensation, like W-2 wages, this is also capped at $100,000 of self-employment income per person, or the $15,385 per owner. The other thing to keep in mind on this is if you have an employee that is an owner, we mentioned you get to include their retirement and health benefits, just as if, but capped at the 2019 levels. And I think there's a question about this that we've had. Even if it's just due to increases in the cost of health insurance, not because you're providing more, we're just still limited for owners to the 2019 amounts. Things are a little bit different for self-employed individuals. If you have a self-employed owner, a Schedule C person, Schedule F, or a general partner, you do not get to count any of the self-employed health insurance or self-employed retirement paid on behalf of one of these individuals, because that's included in the self-employment income. So it's $100,000 of self-employment income. You do not get to add on, though, retirement benefits and health insurance for self-employed individuals. So that then covers the compensation piece of this. So we're still on step one, and we've covered that payroll piece, which again, they want to be at least 75% of the forgiven amount. And mechanically, we'll see how that happens. In addition to that, though, we do get to spend it on other non-payroll costs, one of which, well, actually 3 different types, or 4 different types, I'm sorry. And Mark will lead us through that discussion of non-payroll good costs account.
Thanks, Jeremy. I know we're getting a lot of questions here on some of the mechanics of the payroll calculations, what's in, what's out. As a general matter, I think Jeremy hit upon it. Health insurance premiums, health benefits, dental, vision, and the like are in, subject to the special rule for owners. We also have one question that's popped in on the question of need, which is not a focus of our presentation here today, but there has been subsequent guidance since our last presentation. And here's where we settled on need, just so everyone's on the same page. The SBA is generally going to leave small businesses alone and say that you had the requisite need to take out a PPP loan and to pray for forgiveness if your loan was less than or equal to $2 million. So black and white rule there. If your loan is above $2 million, then there is a more complicated consideration to show what access to other liquidity there was. Again, it's beyond the scope that we were hoping to focus this presentation on, but I think is an important thing to address before we dive too deep into the PPP forgiveness math, because we want everyone to make sure they feel comfortable before they go and request forgiveness that they made that they met the requirements that were certified on the original application. Okay, let me dive in now to our non-payroll good costs, as we call them. And so these are costs, again, that must be paid during the 8-week covered period. And so I'd like to note that the alternative payroll covered period we talked is irrelevant. So any company that elects the alternative payroll covered period for simplicity to align their payroll math with their normal pay cycle is going to have 2 different covered periods, one for payroll costs and one for non-payroll costs. So where there's a simplicity on one side, there's a complication on the other side. So we're talking about the 56 days after the first PPP funds landed in the bank account. And similar to payroll costs, we are also including the amounts incurred and paid on the next regular billing date. So if the phone bill comes at the April 30th and it isn't paid until June 15th, let's say, on a 45-day pay, that's going to be okay. Let's dive into our first here. Mortgage interest is our first good cost. Must be normal, ordinary course of business mortgage interest. So there are some examples you could think of things that are maybe closer to the line. It's a debt, a real liability, and it must be secured. And there's a lot of speculation when the CARES Act came out on this concept of real or personal property. We got an example early on in the guidance of mortgage interest on a business vehicle as an example of a good cost. And so that's the hallmark that we're using to say, the statute says real or personal property, and we have this example that shows a vehicle. And so the concept is that when Congress used the word mortgage, what they really meant was a debt with a security interest in real or personal property. And a key is that the debt on which the interest relates must have been incurred prior to February 15th, 2020. So you can't go out and buy a new Chevy Silverado now and start deducting the interest and including that in your mortgage interest good cost. It needed to be a truck that you had before you knew what COVID was. And a key point is we can't try to cram in more interest by prepaying it in our 8-week period. Jeremy, can you tackle rent and utilities for us?
Yeah, happy to do so. Taking a look at these questions before we begin, I'm going to do the same thing you did, Mark, and try to knock some of these out. So before we get too far removed from payroll, we've got some questions about 401k employer match, matching on various types of retirement plans, 401, 403 plans. Yeah, as far as we know, any of the matching amounts or any amounts paid by the business on behalf of employees for those retirement accounts should count. There shouldn't be a problem with those. Retirement's one of those issues we are waiting on some guidance on. As far as, if somebody wanted to fund an entire year's worth during the 8-week period, there's nothing that explicitly says you can't do that and not get forgiveness for all of it, but they've not explicitly said that we can either. So that's one of those areas where it may work, it seems like it will work, but we just don't have explicit guidance related to that. There's also a question about payroll fees. Payroll fees that are charged to process your payroll do not count, just the actual payroll cost itself. And so I seem to be getting a lot of questions too about this paid and incurred. So just to be clear on that, as Mark well said, anything that is paid at the beginning of the 8 weeks counts, even if it relates to a period where it was incurred prior to. But on the back end, you always get incurred up until the end of the 8-week period, as long as it's paid on the next payroll run. So it's paid or incurred is a way to think about it. You get paid on the front end, and you also get incurred on the back end. Okay, so with that then, rent then is the next non-payroll cost. So same as with all of these other costs that are non-payroll, the leasing arrangement has to be in place and in force before February 15th of 2020. It can't be some lease that comes into agreement that comes into play after that date. Okay, it has to be before February 15th. We're getting a lot of questions on related party rentals. Again, a lot of that where the same owners lease the building to the operating company. Again, this should work as long as, especially if those rentals are at fair market rental rates. Again, these leases had to be in existence. They can't come into play after February 15th. But if they were previously in existence and they represent, fair market rental rates, then there really shouldn't be an issue related to it. And again, some of the risk related to this is also mitigated by that 75-25% payroll versus non-rule, which Mark will talk about a little bit later on in the presentation. One other thing to keep in mind, as with mortgage interest, not only do rents apply to rent of real property, but it also applies to rental of tangible personal property. So if you lease vehicles for use in your business or lease equipment that is used in your business, those rent payments or lease payments should count, assuming the leases are in place prior to February 15th of 2020. Now, a question that I saw, and I may not be able to find it, here we go. So one of the questions that came in is, if our 5-year building lease renews during the covered period or soon afterward, are the rent payments on the new lease ineligible uses of the loan proceeds? I think if it's a renewal of an existing lease, particularly if the original agreement allows for a renewal, to me, by my way of thinking, and Mark can correct me if he disagrees, that is a leasing arrangement that was already in force prior to February 15th. And so I would say you still get to count that. Okay. So the last item then on non-payroll covered cost are utilities. And this should hopefully be one, I think, one of the more straightforward of these. Amounts paid for the following items. Again, these are ones that are explicitly mentioned. If something is not on this list, it doesn't qualify. The main one I'm thinking of is a lot of like trash, for example, trash service. Again, not explicitly included, so I wouldn't count it. But of these, as long as the service began before February 15th of 2020, you get to include electricity, gas, water, telephone, internet, and then they added transportation, which I'm not going to lie, confused us quite a bit at the outset. During other guidance, they indirectly made reference to fuel used in a business vehicle as being part of a good utility cost. So when they say transportation, think of auto fuel for businesses that you use within your, for vehicles that you use within your business. That's what they mean by transportation utilities. So with that then, we finally covered, now only a half hour into the presentation, step one, the good cost. But again, this is important because this is where a lot of the questions that we're getting stem from, and everything else hinges upon what cost did we pay towards good cost. So again, payroll cost, and then rent, utilities, mortgage interest, all of those as well count towards your calculation of good cost, assuming they're paid within the 8 weeks, or they are incurred at the back end of the 8 weeks and paid on the next bill after the 8 weeks. Okay. So once we have that, then we have to sit back and say, okay, now, is there anything about how we're conducting business now that may possibly limit that amount of forgiveness? So we paid the amount for good cost. What limitations are there? And so we'll start with step two then. We have to pay our individual employees enough. We have to pay them the right amount. So with that, I'll turn it back over to Mark to walk us through this step two.
Thanks, Jeremy. And I know, I think you hit it nail on the head. The most important thing is that we don't get to forgiveness without spending the money on the good costs. And so that's important. I know we have a lot of questions. I think we'll try as best we can to get through the material that we have here in front of us over the next 30 minutes. And then we'll hang on for questions and let people trickle off as they need to move on to other things for some of those questions. So the first hurdle we have to clear in order to get full forgiveness after we've spent all the money on all the right things is we need to make sure that we paid our people enough. And so when we think about all the good costs we spent money on and paid during the payroll after the covered period, or on the next invoice cycle for our non-payroll good costs, we're going to add all those up, and let's say that covers our loan exactly. So we're not out of the woods yet, as Jeremy well described, and we need to make sure first that we paid our people enough. And we're going to talk in the future here about some FTE concepts. But here in step two, when we are trying to figure out, did we pay people enough to get full forgiveness, we're asking, did we pay Steve and Janie and Joey enough? We're looking at individual people. So let's look at who gets thrown into and out of this calculation. So we're not going to do this analysis on all of our payroll. We're going to split our payroll into two buckets in the form that the SBA has put out for the PPP loan forgiveness application. has a worksheet that splits out a payroll into 2 categories. So we are going to throw out all of our highly compensated employees, defined as those who had payroll during any pay period in 2019 that would annualize to more than $100,000. So first thing we're going to do is we're going to take our $100,000 plus employees measured based on 2019 pay periods and set them into their own category. The law does not care about them for this purpose. If an employer paid somebody $175 this year and they pay them $76 this year, so be it, not a problem. But if you had an employee that you paid $75 this year and they're going to get cut down to $30,000, that's a potential issue, as we'll see. And also, we're going to include our new employees who didn't have a chance to get tested under the $100,000 test because they joined our business in 2020 and not 2019. So those are who we're going to look at. So there's going to be a mechanical process to take the payroll runs and split them into 2 buckets and to look only at a certain subset of our employees. Jeremy, can you take away, now that we know who we're applying this analysis for, what do we need to do to make sure we pass this test?
Yeah, happy to do that. So what we're doing then is we're wanting to take, again, we're looking to see whether or not we've paid them enough. And so what we're doing is taking that 8-week period, whether it's the 8 weeks immediately after the loan or that alternative covered period, if you decide to use that, you're taking the average pay during that 8 weeks. So either the average annual salary for salaried employees, or you're looking at the average hourly wage for hourly employees. And you're comparing that for that specific employee to what they made, their average annual salary or average hourly wage during Q1 of 2020. And the first question is, was there a reduction? So if you have nothing but hourly employees and they are all making the same hourly rate during the 8-week period as they were during Q1 of 2020, then there is nothing to worry about. If you have not reduced anybody's salary during the 8 weeks versus Q1 2020, you have nothing to worry about. But if you did, if you reduced someone's hourly rate, during the 8 weeks versus Q1, or if you reduce their annual salary during the 8 weeks versus Q1, then we have to look at what is the size of the reduction. If that reduction was more than 25%, then you could get a reduction in the amount of forgiveness equal to the extent the pay reduction exceeds 25%. Okay? Now, here's one thing to keep in mind on this. There's a lot of confusion related to this. As we're going to see in a minute, if you reduce the number of FTEs, there is also a reduction in your forgiveness. Well, one way that you will have an FTE reduction is if people work fewer hours than what they worked before. If somebody is being paid less because they are working fewer hours, that does not count as a reduction in pay under this particular provision. You're going to have an issue related to your FTE count maybe not being high enough, but you are not going to get a reduction in forgiveness based upon amount of pay. So for example, if we have a 40-hour-a-week salaried individual who during Q1 was making $4,000 per pay period for 40 hours a week of work, and then during the covered period, they went down to 20 hours a week, and their pay went down to $2,000 per pay period, there is no problem. There's a reduction in pay, but it's due to a reduction in FTEs. So just keep that in mind. We're talking an apples to apples comparison. Is someone making less, more than 25, did they have a more than 25% reduction for doing the same amount of work that they did during Q1? That's what we're concerned about. Okay, so that's what we mean by this note. So what we're looking at is average salary or wages during the 8-week period. Compare that to Q1. or look at the hourly rate per employee during the 8 weeks, compare that to quarter one. And again, for the same number of hours, if there was a reduction that exceeded 25%, we're going to get a reduction in forgiveness. So that's what we're doing with step 2. With that then, that takes us, so that's the first hurdle that we have to get. After we spend all of the good cost, we potentially are limited if we don't pay employees the right amount. Mark will take us then through step 3 to determine what happens if we don't pay the right number of people.
Thanks, Jeremy. And so we were just leaving the world where we count Steve and Sally and Janie and figure out whether we reduced individual humans. And now we're going to get into the world where we're just blending everybody together and calculating FTEs. Basic concept. And I know I know this is dense material and we're cramming it into a short period of time. The FTE math that we're doing, the purpose of it is to figure out whether we reduced our workforce as a result of COVID. The purpose of the PPP funds were for the government to fund payroll costs and other good costs during this 8-week period to help businesses get over what Congress and the executive branch and others hoped would be a blip on the radar, that this confidence instilling injection of cash would help to overcome. And so we have a base period and we have our 8-week, 56-day covered period, and we're going to compare the two. There are going to be some choices we have to make on what math we use to do the comparison, and that has come out here in the last couple of weeks. But from a 30,000-foot view level, all we're trying to do here is figure out whether we had a workforce reduction during our covered period where we were supposed to be using PPP funds to keep people off of unemployment, whether we succeeded in doing that for enough employees relative to our baseline count. So let's dive into who's going to count in the FTE. So we are going to look at this, and we'll get into it here in a second on how we actually count people. But again, we're trying to compare the 8-week FTE count to our baseline. Janet, could you jump to the next slide if you would? Thank you. And the important thing for measurement here is that whatever FTE measurement cycle we're going to use for payroll is going to align with our pay cycle we use for measuring payroll good costs under our step 1 of the analysis. So if we elected to use the alternative payroll covered period to align our normal pay periods, our normal payroll periods to our PPP period for payroll costs only, we're going to do the same thing for FTEs. If we didn't make that election, then we're going to use the 56-day period starting the day the money hit our bank account. All right, Jeremy, can you help us to figure out what we do with people that left our employment, but it wasn't our fault?
Yeah, and I know there's a question on this. I'm not sure if I can quickly find it, but one of the open questions does relate to this. So if we could move to the next slide for special rule for voluntary exits. They realize that there are going to be instances when a reduction in FTEs is outside of the control of the business, or the business made a decision prior to getting guidance, related to how these calculations work. And so here's what happens. You will not have a reduction in FTEs if either of the following occurred. If someone was laid off or you reduced their hours, but subsequent to that, you made a good faith written offer to rehire that individual or to restore their hours at the same rate of pay that they were making before. So you reset everything to where it was prior to either the layoff or the reduction in hours. If you make a good faith written offer and that offer is rejected by the employee, you still get to count that as an FTE. It is not reduced. The only other thing you have to do is you have to maintain proper records that you made the written offer and that offer was rejected. And within 30 days of the rejection, you have to inform the applicable state unemployment office. But if you laid somebody off, reduced their hours, made a good faith effort to bring them back to the exact position they were, and they reject it, and you meet the reporting requirements, you get to count that as an FTE. Or likewise, if the employee voluntarily resigns, if they were fired for cause, and again, you would want to document that, or they voluntarily, and again, the key word here is voluntarily requested and received an hours reduction, keep all of the paperwork associated with that, and that also does not count as a reduction in FTEs. So that's the special rule related to voluntary exits. The only exception to this is if that position or if those hours have already been refilled, then you don't get to use the special rule because you've already restored that. You don't get to count that old FTE on top of the new FTE. So if you've already filled the position, you're fine. You don't have a reduction anyway. You don't worry about the special rule. But if you've not filled the position, then this special exemption, special rule applies. So we've talked a little bit about what we're looking at during the 8 weeks. So what exactly is it that we're comparing it to? Well, we're comparing it to the baseline FTE. So if you were a non-seasonal business, okay, we want to know how many FTEs did you have during the baseline, and then you're going to compare that to FTEs you had during the covered period, the 8 weeks or the 56 days. If it's a non-seasonal business, you get one of two choices. You can either choose the FTE calculation from February 15th of 19 through June 30th of 19, or you can choose January 1st of 2020 through February 29th of 2020. Whichever one of those is lower, that's the one you're going to want to use because you're going to want to increase the likelihood that you do not have a reduction in FTEs. Now, let's say you're a seasonal business, and I'm going to caveat all of this. And again, I'm going to open this up to Mark if he can correct me if I'm mistaken on this. I don't believe we have any guidance that defines what businesses qualify as a seasonal business. In the Act, it leaves it up to the administrator, and I don't think the administrator has made that determination yet. But if we get guidance and we qualify as a seasonal business, you can choose either A or B, those two dates, or you get any consecutive 12-week period between May 1st of 2019 and September 15th of 2019. So again, the same concept. You would try to find the 12 consecutive weeks within that time frame that produce the lowest base FTE count. So we've covered, what we want to look at during the 8 weeks and how to calculate FTEs. We've talked about the baseline. Mark is going to walk us through an example of how this calculation works.
All right, thanks, Jeremy. So we have a company that did almost all of their homework. They got $210K. They spent 140 on payroll, 60 on non-payroll, total of 200 spent. So there's 10,000 that we know they are going to have to pay back. Trust us on the math here. 8-week FTEs. We count them up and we get to 18. We'll talk about how we count here in a second. The base FTEs, we picked the lowest of our possible base periods, and 20 was our base. And so because our 8-week FTEs were only 18, we've had a 10% reduction in our workforce. And so we are going to get a haircut on our potential forgiveness, which was $200,000 before. We're facing a potential haircut. I like Jeremy's analogy. It's not a guillotine either. This one is a haircut as well. And we'll find out here in a second that there's a chance to cure this defect. But here, our company A has thought that it did everything that it was supposed to do, but because it had a reduction in its FTEs during the covered period, there is a potential reduction. So let's advance to the next slide and figure out how we came up with that 18 count. So if our employees are full-time, they work 40 hours or more on average, they count as one. Set them aside. If employees work less than 40 hours a week on average, then we are going to do either of two math calculations. Either we can count everyone who worked less than 40 hours a week as half a person, or we can round to the nearest tenth the portion of a 40-hour work week worked. So a 36-hour person would be 0.9. And so we can use either of those. And for companies who are facing a haircut, there'll be some incentive to run the math both ways and see which of them produces the best forgiveness result. All right, so that's pay people the right amount. As I alluded, problems with not paying people the right amount or not paying enough people can be cured. And so we're going to spend some time with Jeremy leading us through how to fix it.
Yeah, so thank you. So nothing can be simple, right? So it's, do you spend the right money? Do you spend the money on the right cost? Okay, great. But if you don't employ the right number of people, if you've had a reduction in wages, or you're not paying, reduction in employees, or if you have a reduction in the amount you pay them, you may potentially be limited. But there's an exception. There is a rehire, what we've called like a rehire provision associated with this. So there are still ways to fix this. I'm just going to say right at the outset, you'll notice there's an open questions section there that Mark is going to get to at the very end of this. This is the one area that still has the most open items associated with it. We will talk about it conceptually, but there are still, in my mind at least, I think Mark's mind, questions about how this is going to be calculated. This is one of those items that I had hoped would be answered on the guidance we got over the weekend. This is something that we really need an example of, and we do not have it. But let's discuss conceptually what it is that we're trying to do. So let's say we had the reduction in wages. Okay, let's go in order. So it's a problem with that second step. We had a more than 25% reduction in someone who made less than $100,000 a year during 2019. Okay. We can ignore that reduction if the employer, quote, eliminates the reduction for every affected employee or by June 30th of 2020. You can reduce it on an employee by employee basis and get rid of the reduction on an employee by employee basis. So you've reduced their wages by more than 25% over Q1. If you eliminate that reduction by June 30th of 2020, you are not punished for that. Now the problem is, as Mark will get to in a minute, we don't know what exactly they mean by eliminate the reduction. There are a number of ways that you can think of that could be possible answers to how to do this, whether it's a point in time or a period of time. But if you make it right by June 30th, you're okay. So that's step 2. Let's say you had a reduction in FTEs. If the 8-week FTE count was less than what it was during the base period, whichever base period it was you chose, and then well, here's the funny thing about this. And if the FTE count was reduced between February 15th of 2020 and April 26th, then you get a chance to make it right and eliminate the reduction. Okay? So let me say that one more time because I think it bears repeating. You're comparing the 8-week FTE count to a baseline. If the 8-week FTE count is less than what it is in the baseline, you then go to a new baseline. You go to February 15th and you say, was any of the reduction, did it occur after February 15th and before April 26th? They want to know whether it was COVID related. So if you had a reduction, say in January of 2020, you're going to have a reduction in forgiveness and you cannot make it right via this rule, okay? Because it has to be a reduction that occurred after February 15th. So reduction from 8-week period over baseline, you then look at February 15th. And if you had a reduction after February 15th, If you eliminate that reduction by June 30th, so you get your FTE count by June 30th at the latest, back up to the February 15th levels, then you're okay. So they switched measurement periods on us. In addition to that, when we first got the guidance, February 15th, the funny thing about it was it's actually a Saturday. So how do you compute FTEs on a Saturday? Well, let's take a look at the next slide. And they answer that for us by saying, when we refer to the February 15th FTE count, we want to know what were your average FTEs for the entire pay period that included February 15th. Okay? So to reiterate, this measurement for the safe harbor, you take a look at the average FTEs for the February 15th through April 26th date. And again, you have to use the same methodology you used before. You're either using actual hours or you're using the 40-hour person counts as 1, part-time counts as 0.5. You then look at the FTEs for the pay period that included February 15th. If the average FTEs under number 1 is less than what it was under number 2, then you have to get the FTE total by June 30th to be at least as great as what it was under number 2. If you do that, the safe harbor's met, and you don't, that reduction that you had in FTEs over the base period is irrelevant. Again, this is complicated stuff because they keep moving the pay periods on us. In addition to that, there are a lot of open questions. So I'm going to throw it back to Mark to discuss what some of these open items are.
I know we're running a little bit long, and this will be recorded if anybody needs to drop off, and so you can pick up right back where we are. The open questions, some of them, we have June 30 FTEs. Is that the pay period including June 30? Is that the pay period before June 30? Is that some sort of head count on June 30? We don't really know what that means. We threw the statutory language at you, which we never like to do because it means we don't know what the answer is. And we don't know what it means to restore a pay reduction. Does that mean that it's on an average basis? Does that mean that on a go-forward basis, the pay rate is restored? As of right now, with the guidance we'd have, I'd say whichever one we can find that produces an argument that the person has been restored, we'd go with it. But that's something where we would like to have some additional guidance is what is a restoration of a pay reduction, and does it mean that if I've taken somebody from $4,000 a month to $3,000 a month, or to $2,750 a month, let's say, so I have a big old pay reduction for the 8-week period, do I need to get them back to an average pay rate? So I have to make up the hole that we dug by paying them too little during that period? Or is it on a cutoff basis where as long as I fix the glitch and pay them the right amount going forward, we're okay, and I don't have to make up the back pay as an employer? So still some unanswered questions on how we get to the math on that, but the important thing to consider, that all of this is irrelevant to somebody who didn't have a workforce reduction, didn't have a pay reduction in their business. We only care about this if during the 8-week period there was more than a 25% reduction of pay for any of our sub $100,000 employees, or if we had a reduction in our FTE count relative to the baseline. So let's talk quickly about something that isn't part of the statute, and that's step number 5, the SBA cap. We're giving the SBA credit for this one on what portion of our good costs can be payroll versus non-payroll. So this is one that, as Jeremy alluded to at the beginning, that it's caused lots of confusion, especially due to popular press reporting. But when we get done doing the math, we're going to calculate our maximum forgiveness. We're going to calculate the potential haircuts. We're going to figure out whether we cured those potential haircuts. And then we're going to do a check at the end and make sure at least 75% of the forgiveness amount was supported by payroll costs. And so let's skip to the next slide and we'll look at an example. It's the best way to internalize this. So we borrowed 210, remember, we had 200,000 in total good cost, 140 of that was payroll. Maximum forgiveness was 200 because we didn't spend 10 that was deposited in our bank account on good cost within the 8-week period. And so we're going to need to make sure that of our forgiveness amount that we're requesting, 200,000, that at least 75% of that is supported by payroll costs. And you'll see the math here that in order to get to that, too much of our 200,000 of good costs are coming from non-payroll costs. So rent, mortgage interest, utilities are making up too much of our forgiveness request. And so what we do is we say $140,000 is our payroll costs. We can divide that by 75%, which is the same as multiplying it by 4/3, and we come up with 186.7. And so we have a 186.7. We're going to subtract out the 140,000 of payroll costs, and that becomes a cap on our non-payroll good costs. And if we get tripped up by this 75% rule, there's no chance to cure it unless Congress fixes it here in the next few weeks. So that's been discussed and is out there. Again, this is the concept of this was that SBA was trying to make sure businesses had an incentive to use the funds for what Congress intended, which was mostly payroll costs where they get 75%. They made it up based on the fact that the loan amount was calculated at 2.5 times monthly payroll. And so they said, okay, well, that implies that 2 months out of 2.5 months should be payroll cost is kind of the back math that SBA did to get that. So again, SBA administratively came up with that rule, and we'll see whether Congress can fix it. All right, Jeremy, can you help us put it all together, and then we'll close it out?
Yeah, so we've done all of this. We've paid the right amounts. We've looked to see whether we had any haircuts. We tried to make it right. This will be, I promise you, I think the easiest math that we do in this presentation. So when we look at forgiveness, the last thing you're going to do on this application is you're going to look at the loan amount. What was the total amount that I received in PPP loans? I'm then going to look at my total cost reduced by any haircuts in steps 2 and 3, but only if not cured in step 4. Okay, so all that stuff we've done that made up the majority of this, I look at that amount, that adjusted total good cost, and then I do that final haircut that's causing so much grief related to the 75%. I take my payroll cost, I divide it by 0.75, and I compare A to B to C. Whichever one of those numbers is lowest, that's the amount of my forgiveness. So let's take a look at a very quick example building off of the same example that we've been using. $210,000 loan, $140,000 of payroll cost, $60,000 of non-payroll for $200,000 of good cost. In addition, our FTEs went down from, I believe, 20 to 18. So when we apply that reduction to the $200,000 of good cost, we get a $20,000 reduction or $180,000 of modified good cost. So let's do the math. On the application, we're going to say, what was our modified good cost? That's $180,000. What was our loan amount? Loan amount was $210,000. What was our payroll cost limit? In other words, what does our total forgiveness have to be in order to mechanically make sure that our payroll costs are at least 75% of the forgiven cost? So we took $140,000 of payroll cost divided by 0.75, and that gives us 186,667. You compare the 3, and our forgiveness amount is our modified good cost total of $180,000. Because $140,000 of payroll cost is more than 75% of 180,000, we don't have to do that final haircut. Okay. So that's how it's going to work on the application. With that, then the only other thing we have to do is to produce the packet of information, and Mark's going to talk us through that, and then wrap this up, and we'll move on to questions, of which we have one or two, I think, waiting.
Yeah, and our plan is we're going to work through those questions. We know people will be dropping off as we go, and that's okay. We're going to get them down on the record, let people make sure that they get their questions answered to the extent we can. So that get the paperwork right. When we look at the form, we say, oh my gosh, this looks like as complicated as an individual income tax return. There's going to be supporting documentations pulled together, primarily payroll related. There's going to be math and reconciliations to agree to show which employees we are excluding and capping and sorting into the two buckets. But when it's all said and done, we're going to run through these 7 steps in paper and put together a packet of information that the lenders who have been deputized by the SBA to enforce this program can then use to determine the amount to communicate to the SBA as being eligible for forgiveness. So we're putting together this packet of information in a way that's supportable and right. So the bank can say, yeah, that's supportable and right, and pass it along to the SBA and say, this is supportable and right. Therefore, in our company A, you should forgive $180,000 of their $210,000 loan. The $30,000 that is not forgiven would be still due as a 1% loan due in 2 years. Everything we say here is subject to congressional approval and revision. There have been a number of discussions pending on extending the time period, the 8-week time period, to something longer, to axing the 75% rule we covered. Stay tuned for further developments, but this is based on what we know now. And if we think back to our example, the way to help that company do better is they're getting hit with $180,000 of loan forgiveness out of a max of 210. If instead they had restored the 2 FTEs that they cut, they would have gotten to 186,667 in loan forgiveness. So they would have picked up another almost $7,000. And if they would have increased their payroll costs relative to total cost, then they could have potentially gotten to full forgiveness. So that's a Cliff's Notes version of getting the paperwork right. The banks are working, I know, to get checklists of what information they want to have in their file to supplement the SBA required documentation, or to organize the SBA required documentation. And so work with your banks as they're generating those checklists. And WK is here as a resource. We are still trying to figure out the best way for us to help people with this process. I know there are some on this call for whom we will likely complete the application from A to B. And there are others that may need to just bounce a question or two off of us. And, whether the 8-week period gets expanded or stays at 8 weeks will be a big factor that affects how close many companies are to having full forgiveness, how important some of these definitions are to achieving full forgiveness, and therefore the level of precision and analysis that is valuable to optimize forgiveness. So we thank you for your time and attention. We're sorry that we did run long with the core presentation. Jeremy, anything else to close it out before we open it for questions?
No, I think that's well said. Again, we're happy to help in any way we can. The other thing to keep in mind, big picture, is that a lot of concern about using this money for the right reasons. And a lot of that, thankfully, as Mark mentioned earlier, wasn't part of our presentation, but he alluded to it. The worst case that happens on this is that if it doesn't make business sense, if you've had one of these reductions, either in wages or employees, and it doesn't make business sense to be able to fix those problems by June 30th, and let's say we don't get any additional help from Congress that extends the period, for example, all we're looking at is a non-forgiven loan at a relatively low interest rate of 1%, payable over 2 years. Okay, we've just converted it to a loan, which is what, not really converted it, but kept it as a loan. There's not going to be any punishment for not using it. Again, as long as you continue to use it for those costs, it may not be forgiven, but there's no harm in doing that, So again, make the right business decision, and we'll do what we can to try to maximize the forgiveness within that framework. So with that, I guess, Mark, you want to just start, I guess we can start tackling questions. We're under triple digits, so let's probably get moving on it so we can stay below that amount. I'm just going to go in order. I'll start with the first one. Health insurance is self-insured. Is forgiveness calculated on cash paid claims or the accrual basis health insurance cost? I don't know that we have definitive guidance on this. I think what I would recommend, Mark can chime in here, but I would recommend just use the accrual basis. Again, that's what most closely aligns with your insurance premium. So I would use accrual basis for health insurance cost. Next question.
Jeremy, I was just going to say, I think that's reasonable. And, with a lot of this, it's quite possible we're going to have some companies applying for forgiveness potentially next week, or starting their applications next week. And so, it's quite likely that we don't have 100% guidance on all of these questions, and reasonableness, I think, is going to be kind of the ultimate test on some of these figures, on these more nuanced questions.
I think that's right. And one other question, this was not in here, but it was in a question we got before this, before the webinar, was related to the relationship with the banks. Do we recommend having banks? Do we recommend borrowers stay close to the lenders? And will the banks have any sway over whether the SBA forgives these costs? And yes, I would recommend you stay close to your advisors. I recommend that includes your banks and the lenders in this situation. And the way this is going to work is the banks will be the ones actually making the determination of forgiveness. They will be sending that information to SBA. All of these loans will have to go through the banks. All of these applications will have to go through the banks, and the banks will be doing the approval of the forgiveness based upon the calculations and the information provided. Okay? That's still the representation of the borrower. But the banks, all of these will go through the banks. SBA will then receive the information. SBA reserves the right to review them, but they are not going to review all of these applications. So the forgiveness really does happen at the bank level based upon the representations of the borrower. Again, if it's an over $2 million loan, those we know are going to be examined. If it's under $2 million, SBA reserves the right to come in and change the amount of forgiveness in any circumstance, or change whether that you qualified. But if you're under that $2 million, there's no guarantee that the SBA is going to do a further review. These next two questions are, I think, related in some ways. Let me reiterate or be clear on this in case I wasn't. We never get to count the employer portion of FICA in the payroll calculation. Never, ever, 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 never. Not the employer. The employees included because it's included in base wages. You don't reduce the employee pay by the employee share, nor do you get to add the employee share on top of gross wages. Okay. So yeah, never count the employer portion of self-employment tax. Now, as it relates to senior executives who earn more than $100,000, I've not seen anything related to officers. The limitation is related to owners. But if these individuals are on a W-2 basis, they get their gross salary up to $100,000, prorated for the 8 weeks. And then you get the employer share of health insurance contributions and retirement benefits for those folks as you would anybody else, but you do not get the employer portion of FICA. If they are owners, you get the same thing, but it's all limited to what the 2019 amounts were. So you can't exceed what those amounts were in 2019. I think we answered this question. You have to pay them. If you reduce their hours, you get an FTE reduction that will reduce your forgiveness calc, but you don't get dinged or you don't get hurt from not paying them the right amount. If you're paying them less because they're working less, that's okay.
Jeremy, so that question was on whether the maintaining payroll was a requisite for forgiveness, and I think we covered that with the steps 1 through 6 math of if you reduced your workforce, you probably squeezed your payroll to the point where it's going to be difficult to get to full forgiveness. But the separating the payment of good costs from the haircut of the good costs that you did pay for having a workforce reduction, we can cure that haircut by getting back to our February 15th level of FTEs by June 30th. So that part can be fixed. What you can't fix is that you've stripped out of good costs the payroll that you would have otherwise paid to those people, which is going to conceptually make it challenging to get back to full forgiveness.
Thank you. Next 2 questions are somewhat related. Again, so regardless of when those funds at the beginning of the period were earned, we don't care that you're on a cash basis at the beginning. That's the good news. So it's really good news on both situations. So received funds, it doesn't matter what dates that those related to for the first payroll after. Even if it was before the 8 weeks, you still get accounted on a cash basis. If it's on the back end, you do. So in this example, our 55th day hits on July 1st. Our pay date is July 2nd. So we can't count that one. No, you can. You get to count all of the days that were earned during your 56 weeks or 56 day period, your 8 week period, even if they weren't paid, so long as they are paid on that July 2nd payroll in your example. And I think Leslie's question gets at the same thing. So cash basis on the front end, accrual basis on the back end of this. You don't have to accelerate a payday into the 8 weeks. If people have worked it and have earned it at the end of the 8 weeks, it counts as long as it's paid on the next payroll after the 8 weeks. No, if you have employees that resign for personal reasons, that's a voluntary resignation. That doesn't hurt you from an FTE standpoint.
That's right. Again, they left, you didn't pay them, so you don't have them in your good costs, but you're not going to get a reduction for them. And that was the math that we ran through where we had somebody voluntarily leave and we said, hey, do you want your job back? And they say no.
This next question's the same. You get it what you paid at the beginning. This one, this is a good question. And I'll follow up with you on this one. So purchased a business in July of 2019, did not take a draw or SE income. Am I eligible to claim the $15,385? I don't believe we have guidance on this yet. They acknowledge the fact, they being Treasury, acknowledge the fact that Schedule C calculation for self-employed individuals doesn't work if you were not in business during 2019, but you were in business before February 18th. So as we sit here right now, I don't know how to answer that question. I don't believe we've received guidance on it, but they realize they have to provide us guidance about those businesses that are now in place and impacted by this, but were not in place during 2019. Is that your understanding on that, Mark?
Yeah, I think you hit the nail on the head there.
Okay.
All right. Lots of questions on this concept of the 56-day period for counting. So we had an example of a company with a weekly payroll for hourly people and a bi-monthly salaried payroll running side by side. And the question is what to do with those things. We don't know whether we're going to be able to use the alternative payroll period for one of them. I think right now, the likelihood is that the difference is because we get to count funds paid within the 8-week period or incurred but unpaid at the end of the 8-week period. Under either scenario, SBA is relying on a belief that for weekly and biweekly payrolls that there's going to be an immaterial difference between those two. It's a simplicity measure, and we shouldn't be skewing the results. So from that perspective, if you have a complicated payroll cycle, I'd say that we're sticking to the normal 8-week covered period for you and applying it consistently for all the payrolls. Is that your thought too, Jeremy?
Yeah, it is. And I think that's it. There may be a way you can eke out a little bit different outcome if you use the alternative period that lines up. But given the fact they limited it to biweekly or weekly, they don't expect it to be materially different. In other words, it's not really a game you win or lose from a forgiveness standpoint. There might be a slight difference. The main issue is just, does it make your life easier by perfectly aligning your 8 weeks with a clean payroll period? It's an administrative convenience. So yeah, I think if things are really complicated, the fact that you get the incurred on the back end, like you exactly said, Mark, I think that takes away a lot of that risk where you don't, the need to move to the alternative period strictly to get forgiveness. We don't really have that problem given the fact we have incurred on the back end of this. So that appears to be, okay, so that's a paid and incurred. I don't know what this next comment is, but it's my favorite comment so far, but that wasn't in the original rules. I wish I knew. I'm sorry. Type in what you were specifically referring to, but something wasn't in the original rules. Does that matter when you applied? There are unfortunately a lot of things, or at least a handful of things that were not in the original rules that have now come into play now. For example, the 75% limitation in some of these other items, that wasn't really in there. Limitation on owner comp, for example, the fact that it has to be based upon it can't exceed 2019. That's one of those items as well. It stinks, but that's what we have to live with associated with this. You guys have heard the cliche. You've read it probably. I've seen a Wall Street Journal article. It's references. They are flying, they are building the plane while they're in midair flying it. And that's just unfortunately what we're dealing with. And that adds to some of the complexity related to this.
Next question was whether an SE owner must actually take the cash out of the business to have it be forgiven. The answer is no. They're using tax accounting concepts to calculate SE owner income based on 2019 results. So that was their answer to try to prevent people from gaming 2020. Was to say, well, let's look at what already happened in 2019 when you didn't know anything about COVID and use that as true north. So for some businesses that depreciated a bunch of stuff and are showing zero SE income on their Schedule C or their farming activity on their return, it shut them out. It shut them out of the PPP program.
Next question, if we're outside the boundaries of expenses, can we return the funds and correct this? Yes. In other words, if your forgivable expenses, you say you've gone over the 8-week equivalent on health insurance. In other words, whenever you apply for forgiveness, you're only going to include the amount that is forgivable, subject to all of those limitations that we talked about, even if we didn't know about them at the time. All that means is if the forgiveness amount is less than what your loan originally was, you just have a loan. So you're exactly right. You pay it back as a loan, no harm, no foul associated with that.
Jeremy, next one was on this retirement question, which we had to kind of breeze through for interest of time. But retirement, I think, is one of the areas that there's a lot of unanswered questions surrounding. If we paid last year's within the period, does it count based on what we know now, we think the answer is yes. Is it 850 seconds? No, we think it's all of it. What if we normally pay in January? Right now, we don't have a special rule that allows us to accrue that back. Remember, we have some special rules for accrual, but this is one that kind of looks and smells a little bit like the SE Health or the self-funded or captive health question that we had a minute ago, Jeremy. Of what do I do with non-cash book expenses that are paid on a regular cycle, just not during this 8-week cycle? And in the absence of other guidance, I think we're having business owners think about paying at least 850 seconds of that within the 8-week period, or being prepared to if it's important to get forgiveness.
Yeah, I agree. The 850 seconds of that amount is safe. And if you had planned on paying it anyway, or more than that during the 8 weeks, pay it during the 8 weeks and we'll hope for forgiveness. You know what I mean? Yeah. If that's already the decision you're going to make. But yeah, more to come on that.
I think that's the answer for PPP forgiveness maximization perspective. I think you want to check with your plan advisors on your specific retirement plan and see what differences that makes in terms of vesting and other things. Again, if you're spending the government's money, so to speak, and you're going to have to pay it back, if you don't accelerate the payment, you don't have as much to lose with a vesting issue as you would otherwise if it was the business owner's money. But
bottom line on all of this, don't make a decision that puts you in a bad situation. Like you said, talk to those that are handling your retirement accounts. Don't let the decision for forgiveness drive a decision that may not be the right one for your business. S Corp Comp. Oh, this is a techie question. Should it be included in Table 1 of the forgiveness app, or they should be excluded and only noted on line 9? I think, given the fact they talk about owner employees and given the separate limits, my assumption is S Corp and C Corp owner compensation belongs on line 9.
I think that's right. An example, if we had more time, we would have pulled the Mnuchin quote where he was where he said, from his perspective, all open questions have been answered. Clearly they're not all answered, and we have a 12-page document or so that is telling us what to do with all of these complicated things. Or 8-page document. I'm sorry. So there are a few holes. Apologize for that.
Yeah. Next question. Yes. So amounts included in non-payroll good cost. If you pay the bill in the next regular billing cycle, you do need to prorate that. You only get the amount of that bill that applies to the period of time within the 8 weeks. You don't get all of it. So if that bill straddles both covered period and post-covered period, you only get the amount that covers the covered period. Loan refinancing. Next question. If a loan is refinanced dollar for dollar after 2/15, is the interest still okay to include as a good cost? I'm hesitating to see if Mark will jump in on this one, but I think I would.
I think it hits on your lease renewal question, Jeremy, and there could be a difference between whether the note matured or whether it was a rate-driven refi.
Exactly.
But I think the intention that Congress and the SBA have here is to prevent people from using this as an opportunity to go on a spending spree.
Right.
So my reaction, based on the guidance that we have today, I'd say that I would feel comfortable taking the position it's a good cost. But that's not to say that it is impenetrable in that view. And I think there's a good argument that a debt that was existing February 15th and subsequently refinanced would be a good cost. Now, if you refinanced it at a higher interest rate, I might be inclined to prorate that interest a little bit or consider that. But again, I think the unfortunate thing is if we get no more guidance before these applications start flowing into banks, some of these gray area questions are going to be resolved by accountants and bankers. And and it's going to be kind of a what could you sit across the table with a straight face and put out there.
Yeah, that's exactly right. Bi-monthly. So next questions. We still seem to be stuck at 90 questions. Is it correct that bi-monthly payroll does not qualify? That's correct. It has to be bi-weekly. Twice a month doesn't count. Every other week counts, or weekly. So, and on payroll, any guidance for hazard pay or bonuses? I apologize. I don't recall if I mentioned this during the salary and wage section, but bonuses are okay. Hazard pay is okay. You're still subject to the limitations, though. In no instance can any one employee's comp during the 8 weeks. You can't get forgiveness on any more than the $15,385, but those count. So if I didn't, I meant to mention that. If I didn't, I apologize. I'll have to go back to the audio and see if I mentioned it.
Yeah, and I think the safe thing, I can't remember if I mentioned it on this call or on a call I had with a client preceding this call, but I think the safe thing to do on hazard pay or bonuses or discretionary type pay items is to get those actually paid within the 8-week period. So I'm not sure you want to be relying on this paid or incurred with something as willy-nilly as a discretionary bonus.
That's right. I think the argument that SBA is going to make is that it really wasn't paid. I mean, I guess even if you would have to pay it out on the next payroll at the very minimum, but I think that's a dicey proposition to me as well. So I would make sure that was on a cash basis and paid during the 8 weeks. Next question, can S-Corp include both the W-2 wages of an employee owner as well as the income draws? No. If you're an S-Corp owner, you get it on the wages like any other employee. You do not get it on your draw of the income or your pro rata share of the income. Company-owned autos, yes. Mortgage on real or personal property. So if you have auto loans for autos used in your trade or business, yes. Any interest deduct that is accrued, and accrued and paid, or incurred at the end and paid in the next on the next bill, that does count.
Yeah. So just to clarify, James used the word deduct, which maybe segues to a point that we didn't make during the core of the presentation. So we think that question meant, do we get to count the interest as a good cost? And Jeremy answered the question in the affirmative. The deduction for interest is one of those things that we're still looking to Washington to figure out. Jeremy and my view is that Congress clearly intended for the forgiven amount to be tax-free income and for businesses to otherwise be able to deduct the payments that they make for good costs. Congress did not use the right words to accomplish that result. They covered the forgiveness, but did not specifically provide that the expenses are deductible. And Treasury's view is, under existing case law, that the expenses related to tax-free income need to be allocated to the tax-free income and become non-deductible. We see that with advisory fees, for example, paid up related to muni bonds would be an example where we see that before. So that's something where we're still looking to Washington to come up with the answer to the question. The way I describe it to clients is Congress said it's tax-free income, the forgiveness, but in essence, because of this technicality, it's not. It's as though the forgiven loan were taxable income. And so we'll see if Congress restores that result. Thus far, they've said, Treasury, that's not what we meant, or members of Congress have said, Treasury, that's not what we meant. We hope that you will fix your guidance. And I think Treasury's response is going to be, our guidance is based on the law that exists today. If you want to change the law, then change the law. And so we'll see if Congress does.
Yeah, I've gone on the record quite a bit saying that had to be the outcome. And even though I think they got to the right IRS outcome, it obviously wasn't the intention. So if employer pays for health, dental, vision, and life, do they all count or just health? I would say health, dental, vision is good. You snuck life in there. I wouldn't include life. Lease agreement, I did look that up, and lease agreements are one of those items that are requested and that have to be included.
That's exactly right. And so for some businesses, especially those with multiple real estate locations, the forgiveness packet could be fairly thick.
This next question on paid and incurred, this individual is exactly right. You can get more than 8 weeks in theory based upon it, because you get everything paid and incurred during the 8 weeks. And if it works out, you've got some paid for prior to the 8 week period. So that counts. Extension of the lease, that's the one I think I mentioned and couldn't find to clear. So if the lease was already in effect and there was an extension of an existing lease, that should be fine. Storage shed rent, I don't see any reason why that would not qualify, assuming we're talking about a business and not personal. So I think we're good on that one. Equipment fuel for transportation cost. I think I would make the argument, they've not explicitly said, but there again, they've not explicitly said any, they've not really provided any formal guidance on this. So I don't know, Mark, what do you think about equipment fuel?
I don't think it's fitting under, I don't know that I would try to fit it under transportation costs where we had another fuel example. But let me get back here to our non-payroll good costs.
I mean,
I think that a gas, it looks more like gas or electricity distribution, that we're not discriminating whether you have an electric stove, a gas stove, or a propane stove. Yeah. We're going to give you the utilities on that equipment used in the business. So I'd take it if I were you, and
you're right,
and track it.
Yeah, I wouldn't get it confused. Yeah, and that's what I did. I got it confused with transportation cost, but no, that's a good utility cost. No worse. Yeah, it's same as, I shouldn't say worse, but same concept as electric or gas you pay to run equipment. So utilities, do point of sale fees count? Not that I'm aware of related to that. Again, it's a very clear, at least I don't know, Mark.
I think we've seen several questions on fees that are incidental to some of these transactions. I'd say that, taxes and fees on a phone bill, I think, are in. Yeah. The point of sale fees are driven by revenue, not by expenses, and everything else on here is expense based.
Driven.
Yeah. And so if you had an expense to get internet access, as I said, those fees and taxes that get lumped into there, I think they're in. I wouldn't take it on point of sale. I wouldn't take it on professional fees to run payroll. Right. I'd keep those clean.
Yeah, like some of this fire service on water bills that came up. Yep. Yeah, I think I would take it on a case-by-case basis. That one's probably okay. Depending, again, if it's de minimis, I really wouldn't worry about it. A lot of cell phone. I noticed this while we were speaking, and I should have answered. There's going to be a bunch of these in here. Cell phones count, whether it's landline, whether it's a cell phone. Internet expenses for remote workers, if the business is picking that up, and it's not included on the employee's comp. In other words, if it's being deducted as salary, but generally that's going to be that is a reimbursable expense, not includable in income. I would hope that would, if you have the right type of plan. So I would include internet costs that's paid by the business. Cell phones, landline, both of those are good. Interest on lines of credit.
I think it comes back to the security interest.
That's securing the line of credit. That's exactly right. If it's secured by real or personal property, you're good. If not, you're not. Credit card payments, utilities, or other non. So the question is, we charge, let's say, utilities and non-payroll cost on the credit card. I would, if you pay off the credit card during the 8 weeks, there's no problem. I think if it's charged to the card, but I would use date charged as the bill date associated with that. And so it really comes down to when was the expenses, when was it related to? Because if you're going to get it for anything incurred during the period, and if it's charged to the card, after your 8 weeks. It's also going to be paid after the 8 weeks. Take whatever relates to the period that was during the 8 weeks.
Yeah, I think that's right. I guess the way I think about the credit card, Jeremy, is that it's a debt of the business, and we should treat it we should do the same math as though you wrote a check to pay Verizon or AT&T and Sprint versus charging it on your card. Do the proration based on the period to which the service related. Treat it as paid on the date charged. Ignore the fact that there's a lag between the date charged and the date the check goes to pay off the bill, or potentially people are putting money on their credit card that's going to stay open for a period of time as cash flow issues work their way out over the coming months. Good Lord willing, and so I guess I'm not that concerned about whether there's actually cash that left the bank account for those, as long as they hit the credit card.
Yeah, that's what I wasn't articulating it well, but that's exactly right. Whatever date it hits the credit card, treat that as the date paid, the bill is paid, and apply the same rules as before. Water, okay, got a handful of utility questions back to back. Sewage cost is not, I don't think I saw sewage in that list.
No, I think sewage we're out on. I think it gets to this bundled question of, places that have water and sewage and trash all bundled together. Yeah. Can you strip it back out or not? For a lot of businesses, it's not going to be a super material number. So on some of these, I think kind of look at it both ways, figure out what the risk is. And we're just going to make some executive decisions as an accounting banker and client team of what's in and what's out.
Yeah. Bond interest be covered under mortgage interest.
I think conceptually it can, but it's a statutory definition, and so we need to look at when it was outstanding, whether it was incurred in the ordinary course of business, what it's secured by.
Yeah.
I feel like if we meet the statutory definition, then by definition it's mortgage interest, and we're good. If we flunk any of those, then it's not. Yeah,
that's one of those unfortunate situations. They use terminology that in a way that is not consistent with the meaning that we usually think of it. So look at the statutory definition and qualifications on that. Rent rack. Okay, so we went rent rack space. Easy for me to say. At a data center, which includes some minor services of maintaining the rack, etc. Is that rent includable? I think so. I don't see why.
Yeah, I think you get into this. We had a question on storage sheds. We have this question on, on this thing. At some point, when I buy a subscription to Google Cloud or something, am I renting a space on their server, or am I buying a service? The line gets gray at some point in time, but I think depending on if the lease is clearly structured as a rental space versus a service agreement, I think that there could be support for including those types of things in rents. And we have rental of tangible personal property anyway. That's a good cost.
Next one's transportation. So then that's where I might have confused it. They mentioned transportation, but again, remember that that's under utilities. So it's very specific. So mileage paid to employees who use personal vehicles, I don't think that would qualify. In theory, some of that is for, gas, fuel, and the like, but I don't know how you would ever untangle that. So I think
that's one that, Jeremy, I haven't known what to do with it. We don't have specific guidance on it. And some of these definitional things, because of the confusing math that we ran through, if the 75% cap holds, we might be fishing for definitional things that end up not mattering in the forgiveness math. So I think on some of these gray areas, it's going to be a case-by-case decision at the time that forgiveness is requested, and feeling out, are we talking about $100, or are we talking about $100,000 on some of these?
And the closer those non-payroll costs, assuming we don't get relief on that, to the extent those non-payroll costs are coming close to the 25% anyway of total forgiveness, then this becomes a lot less relevant. you know, there's no point in adding on to those costs because you're not going to get forgiveness associated with them anyway.
Yeah.
Reimbursement question, same as before. I think you can get that to count.
Jeremy, the accountable plan concept, I think, is what you were hitting on before. Yep. The payroll accounting for reimbursements to employees can happen one of two ways. And if one way it's included in wages, the other way it's not. Most businesses want it to not be included in wages. So Jeremy's answer before was the most businesses rule, but make sure you're not double dipping there.
That's exactly right. PTO hours, vacation hours. Yeah, it's gross pay is pretty broad. The only issue with that is, you know, if it's someone that's close to the 100,000, you're limited to 15,385 during that time frame.
That's right. And we saw that severance is in there as well. And so, yep. I think that's exactly right.
Pension funding, that's our favorite question. Can we count a contribution? We've talked about this already. I think Mark has mentioned this. We definitely know if you count a contribution to the plan during the 8-week period, we know that the proration amount works. As we sit here today, we would say total amount works, but we may get guidance that kills that. This is one we've not received guidance, either an affirmative yay or an affirmative nay associated with it. So I think if it makes sense to pay it during the 8 weeks, if you're comfortable with all of the ramifications of doing that outside of PPP, pay it during the 8 weeks, you know, maybe wait, you know, plan on paying it towards the end of the 8 weeks and what guidance. And if we get no guidance, I think I'd take my chances.
All right. The question, Daryl's question gets at, well, what happens when somebody had a really big paycheck in a week? They got a bonus or something like that. And if you annualize that 1 week payroll, it looks like they made over 100,000. Does that one payroll kick them out? And Jeremy, you want to take that one?
Yeah, but so you want I'm probably a little more aggressive on this. That's why I say I like the question. I would normally say I don't know, but as a very literal reading of the application states that you include in one of the tables anybody, you include them if during no single pay period did they have annualized income of over 100,000. So I think if you have, I think barring any further clarifying guidance, I think there is an argument to be made that if at any one pay period during 2019, you could annualize them out and they annualized over 100,000, what the heck? I would exclude those individuals under a very literal reading of the application.
And I think that's right. I think that from a form perspective, I view the SBA Form 3508, which is the forgiveness application, as similar to IRS instructions. They are instructive, but not necessarily authoritative. And when they aren't written very clearly, there's a lot of things that become gray. And I think this is one of those things that's become gray, but we thought it clear enough to present it on the slides the way we did, which is if we don't want people in the payroll reduction category. The more people we can kick out, the better. So if we have a basis to kick them out, let's exclude them from that table and not calculate them as part of that calculation. Commissioned employees create all sorts of headaches for these payroll calculations.
Yeah, there's a question. Commissioned employees, question mark. I was going to say yes, next question, and move on. Yeah, we've got 3 of these back to back to back. And sorry, Mark, I didn't mean to interrupt, but I think they hit on the right problems associated with them, and that I don't really know. In theory, if you're on a commission basis and the reduction in wages are associated with a reduction in sales, I'm curious as to your opinion, Mark, but that to me sort of smells like, and it seems like that issue where if someone is working fewer hours, you're not hurt by a reduction in their pay. I think I would focus mostly on base, but I don't know that I have any guidance for saying that.
I feel like there's way more unanswered questions in this space than Treasury thinks there are. And I'm with you, Jeremy. I think that You know, you end up with this with overtime questions as well. For hourly workers, if somebody used to be working 60 hours a week and getting 20 hours of overtime, and now they're getting 40 hours a week, to me, that looks and smells like we did exactly what the Act wanted us to do. We continued to employ people full time. And the fact that they're making a considerable amount less is reflective of volume of activity, not on whether we did what we were supposed to. You know, I think it stands to reason that all of this gets fixed if you didn't have a real reduction in your workforce or pay rate, and you quote unquote cure it under the approaches we discussed, subject to the uncertainties we discussed. If you cure it on time by June 30th, then it all becomes a moot point. But our open question on payroll, whether you need to go back and actually make up for lost amounts, is a really gaping hole in what we know or don't know about how that's going to work.
Yeah. So the overtime question, I mean, I think I would, again, I don't know that the application specifically, you know, blesses this. I think I would focus on the base hourly rate and not worry about the overtime portion of that bumping up the average hourly wage. But again, there are still some holes obviously related to guidance. On the application, enter the total number of employees at the time of the application. That is a head count, not an FTE calculation. That was to determine whether or not you qualified. So that was the whole 500 employee issue.
Right. For most, it's under 500. Certain industries have some special rules that test that on a per location basis. Go ahead, Jeremy.
I was going to say the next question is a good one. Mark has kind of talked about this a little bit. I mean, the kind of beyond the scope of what we talked about today. So it's how the $2 million limit without need works. On the original application, this was not a stipulation. If we applied with the original rules, are those the rules we go by, or can we now be penalized since the rules have changed? Generally speaking, you can be penalized because the rules have changed. And they would argue that the rules haven't been changed. So here's what we're talking about. If you have a loan and that you had to certify that there was a need, that taking out the loan was necessary. I'm not going to get the words entirely correct, but to support the operations of the business without causing undue burden on the business, or without being detrimental to the business. And then they talked about it. So it was a certifying to whether it was required, whether you needed the funds. And that was very broadly based about whether you needed the funds. They wrote the law in such a way to try to make it a big tent where everybody would qualify. And then suddenly everybody qualified, and businesses that they may not have wanted to qualify due to political reasons after the fact, or, you know, they said, okay, look, we're really going to take a look at whether or not you can certify that you had a need. And that caused everybody to be concerned about this, including most businesses that had absolutely no reason to worry. They gave us some relief on this. If the loan is, I believe, is it less than or equal? I need to look at the application.
Well, they say it different ways in different places.
Okay.
The way the application says it is that loans over $2 million are going to be subject to the additional scrutiny.
Yes.
So if you hit the magic number right on the head, then what I think is you're going to answer that box no, or you're not. Right. It's going to be an unchecked box on the form, and you're going to skate through with the person who had $100,000 PPP loan.
That's right. And the thing to keep in mind is if the loan is under that limit, whether it's $2 million or, whether it's less than or equal or less than $2 million, if your loan is less than that amount, there is a safe harbor. You are deemed to meet the good faith certification, period, end of story, because your loan was small enough. They're assuming if a business needed a loan that was less than $2 million or less than and equal to $2 million, then you were a small enough business, you didn't have access to capital that would cause in such a way that would cause you to not meet the need certification. If your loan is over that amount, nothing wrong with that, but your loan is going to be examined, and you need to be, gathering the documentation that shows here's what our thought process was at the time we applied. So that's where the time of the application comes into play. What was our thought process? What could have happened to us based upon how things were during that during that period when we got the loan? And even if things didn't quite work out that way during the 8 weeks, that's okay. But you need to be able to document what your thought process was, both here are my potential needs, here are the potential closures and reductions in business, here's the other sources of capital that I have access to. Put all of that together and come up with something that demonstrates that you needed to take this out. And so again, just because it's over 2 million doesn't mean it doesn't qualify. But you definitely need to be able to have that evidence. And I realize it's frustrating because whenever everyone took out the application, they were encouraging every business to do it and saying this is going to be an easy process. But the rules, as they have with a lot of these things, did change midway. The good news is if your application is small enough, they did finally take that back off the table as a consideration. All right, next questions. So unemployment cost incurred by former employees who left us, then their new employers furloughed. Oh, okay, so that's kind of beyond, I think, what we're talking about. So let's see, we claimed unemployment costs, or new employers furloughed them. Now we're back on the hook for the unemployment. I'm not sure that those from just purely a PPP standpoint, I'm not sure any of that qualifies. I'm not, can't really speak to the other issue associated with that. Mark, anything to add associated with that?
No, let's move on and try to get under 50 questions here.
Yeah, let's see what
we can do it.
All right.
Go ahead.
Sorry, Mark, go ahead.
So this is a group that had has Q1 as a base and had a lot of hourly employees. Half of those humans were gone as of the middle of the 8-week time period. So the question is, when we're looking at the wage reduction, do we just throw out the people who aren't here at the end of our 8-week period? Or do we have to look at them on a prorated basis for the wages they earned before they left? And I'm pausing because I think I know the answer, but I'm not sure I know the answer.
Yeah, I think you have to probably look at it during the period of time that they were employed.
Right. If they're truly hourly, I think what we're saying is we're going to take their hourly rate and we're going to compare their hourly rate for the pay periods they worked within the covered period, compare that to the prior, and if they had more than a 25% reduction, then we have a potential problem. And to the extent they're not here anymore, the only way to fix that problem is to mail them a check to make up the difference, or just to swallow the potential reduction.
Yeah. FTE, someone who quit, again, document that they left voluntarily, and you're fine. You don't get dinged or punished for a lack of FTEs or a reduction in FTEs. New employees' salary absolutely can be included if it's paid or incurred under those rules. As long as you meet those rules within the 8 weeks, you're fine. They don't have to be an employee during the base period or any period prior.
That's right. The starting point is all gross compensation paid during that period, and the primary limit is the $15,385.
Quarter of an FTE. It's going to be an average of an average. So if they were an FTE, you look at you take your average FTEs for each pay period within that 8 weeks, and you average it all up. So you're going to get kind of a weighted average of that. If they were a 0.4 and you had them for half the time, that should, I think the math should work out to 0.2. is how it's going to work out for you.
Good.
Number of
If an
hours.
employer reduces the number of hours per day, but the employee still produces the same amount per day, is that going to cause any sort of penalty in the PPP loan math?
If they were full-time and went to something less than full-time, it's going to hurt your FTE calculation.
If you're treating them as not full-time, right? So if somebody,
when do they say reduce number of hours per day? So let's say
somebody worked 45 hours a week on average before.
Yeah.
And they're working 36 now.
Correct.
And getting about the same production out.
Yeah.
I think if the business is treating them as full-time, they count as one. Is there a hole in that, Jeremy?
if they still average, it depends on when you reduce their hours. You just have to look at whether they were average of 40 hours a week or not. And I think if you can still make an argument that they're 40 hours a week, if the numbers bear that out, you're fine.
I guess where I was going
is a bunch of overtime. If someone went from 50 hours and then went down to 30, you could probably get the math to work where they were still at average of 40 and count as 1.0.
I'm not sure if this is where the questioner was going with it.
Yeah,
Jeremy, but I guess I'm wondering if a business just says you're doing your job, I don't really care how many hours you work. You were salaried before, you're still salaried, get your job done. I guess if there is no timesheet, they're being treated as working 40 still.
That's a good point. I mean, that's a question we've not really, haven't really broached in this yet. But, when we talk about FTE counts, it's assuming you maintain the records to be able to do that. I mean, I'm assuming if you don't, you do the best you can. And I think you're right. I think an argument like you describe it can be made. I think for those businesses where they are tracking hours, I think it's a pretty mechanical calculation.
Agreed.
Yep. FTE base period does not, applying for the loan, the base period for purposes of calculation of the loan doesn't have to in any way relate to the FTE base period. So no, there's no relationship between those two periods of time.
The maddening thing about this program is that every time you think you know what the relevant period of time is, there's something similar to it that is different, uses a different measurement period.
Yep. Part-time FTEs who are not benefit eligible, they're not FTEs from a benefit standpoint is how I'm reading this, but during the summer months they work full-time hours. Absolutely. Should I consider them FTEs for the purpose of forgiveness? Yes. Again, it's a mechanical calculation. Take the number of average hours and that gives you your FTE regardless of whether you would count them as an FTE for any other purpose.
It's a totally unique concept here. We have PPP FTEs and it's divorced from other concepts.
Daryl continues to have some of my favorite questions on this because I think it's a good one. If a person is salaried but scheduled work week is 39 hours, can they be treated as 0.5 FTE for purposes of the base period as well as the PPP period? If you track hours and they consistently work 39 hours, you can elect to go 0.5 on them. But you have to use 0.5 for, that is not, and to my understanding, not an employee by employee decision. Right. So you're going to have to do that across the board. And if the math works out better that way, great.
Yeah, I think the way the head count's going to work, if someone's facing a limitation, then we're going to run the math both ways and use whichever one is preferable.
This
is timing.
Yeah, I looked this up. It feels like 20 years ago during this presentation. I believe it's when the funds are dispersed. That's what they ask for. So the question is, my bank note is dated April 10th. Loan proceeds were not received until April 13th. Which date's the beginning date? And they asked for the date the PPP loan was dispersed on the application. I'm assuming that's what drives the date.
Yeah, that's exactly right.
Employees that were paid leave under the Families First Act, I mentioned you can't double dip on the salaries. I don't see any reason why the FTEs don't count. So they ask you, can you count the FTEs? Yes. You just don't get to include their wages as good costs to the extent it's a reimbursed expense from the government. But I would count the employees. Prevailing wage question. That's
Yep.
yeah. It's kind of I put that in the same bucket that I do the commissions. You know, I barring any additional guidance, you know, the way to go would be to the way that would be most beneficial would to look at base rate and compare that. But that's one of those where that's a hole in the guidance. We don't know specifically how to calculate that.
We'll post if all the bankers email us after this call and tell us how we've misled people by suggesting that they should use base rate because their bank doesn't feel comfortable with that approach. But I think right now, you know, for all these variable comp type scenarios, we're in a situation where if you hearken back to the intent of the legislation, it seems to be that we don't want to have employers push employees onto the unemployment rolls, and we don't want them to drastically reduce the standard of living for moderate and lower income individuals. And using the base rate seems to still support that intention. Yeah. And so if it's gray and we can justify it, then I think that would be the approach that I'd advocate in most situations.
Yeah. So commission question, same concept. Are we comparing the 8-week period to the same 8-week period in 2019? We are not. You're comparing the 8-week to one of those baselines that were in the slides. And again, we'll make sure we post those slides. This next question I love as well. If we used our whole amount within the 5 weeks and spent only on payroll, does that mean we will probably get maximum forgiveness? I'm afraid whatever I say is going to end up on an application to a bank where someone says, Jeremy Morris, it was Williams Keepers, said we would get maximum forgiveness. I think it's likely. If you paid it all within 5 weeks and you're not, you know, you calculated it correctly, you didn't use more than the 15,000 per, your head count is okay, you know, yeah, and you don't have any other non-payroll costs, seems like a high likelihood, but you've got to work the math. The 8-week period, yes, the baselines are in 2019 baselines. So again, or one of them is. The other, two of one of the normals and one of the seasonals is based upon 2019. They want to know what it was like when things were relatively normal. You do, however, have the option of choosing a January and February 2020 baseline. The emergency grant, that just comes off of the forgiveness. Think of it as so if someone got the EIDL, the EIDL emergency grant, that reduces the amount of your forgiveness, right? It's as if it was a prepayment of the loan amount. You don't get a double dip, I guess, associated with that. You only get it paid back to you once. So the way they mechanically do that is it comes off of the PPP loan forgiveness. I think I've stated that correctly.
Yeah, you did, and we simplified the math in our example. But for those who did get the 10K, that's gonna come off their forgiveness amount.
Yes, bonuses are allowed, but again, I mean, even if they push someone above the 15,000, you just can't include more than 15,385 per employee for any of these calculations during the 8 weeks. But bonuses and hazard pay, they did say we're good. Let's see, someone is a 0.5 FTE and they do not work during the covered period because they resigned.
And they're going to, they're saying, do they come back at 1 or do they come back at half?
The application seems to indicate that that person is a 1 FTE in the covered period. There might be a loophole in the calculation. I would be hesitant to do that. I'll look into it. That obviously wasn't the intention. You know, the intention was if they were a 0.5 and they resigned.
They're not going to count against you, but they don't help you.
Yeah, they don't hurt you, but they don't help you. That's exactly right. You get a 0.5. Now, whether there's a loophole, like I said, great, but I would be hesitant to do that. Yes, bonuses count. Again, just be aware of owner bonus limits. You know, again, owner comp can't exceed what it was prior year, and you can't exceed the 15,385. Okay, the 210 $100,000 example, we're talking about the 75%. Again, this is one of those situations where popular press has not done us any favors on this. And this is one of those do a shot every time you read somebody that writes an article that doesn't get the 75% right. It's not 75% of the loan. It's 75% of the forgiven cost. And so that's mechanically why at the very end you take total payroll cost, you divide it by 0.75, and that sets your limit. It doesn't matter whether your payroll costs are 75% of the loan, completely irrelevant. But again, it's easy to understand because every article on this begins with at least 75% of the loan has to be used to pay payroll, almost without question. And it's entirely wrong in most instances how they're using that. So 75% of the forgiven cost, not total loan, is what we're concerned about.
The math that always gets you to the right answer is take total payroll cost divided by 0.75 or multiplied by 4 and divide by 3, and you'll get the number that that tells you the the maximum forgiveness implied by that.
Morgan says, will you be sending, yes, an Excel spreadsheet or worksheet to help with these calculations? You know, that's something we're you know, there's going to be calculators. We're going to work on that as well. I don't know that we necessarily have, I mean, we can provide that example that we used within, and we will definitely have resources that we use to help with these calculations. So, you know, we'll try to provide that as soon as we can associated.
Yeah. Several of the calculators that were developed as templates before the guidance came out in the last week or so were predicated on the statutory arrangement of things. And as Jeremy can attest, the bubbles that we used for steps 1 through 7 in our presentation about all flipped in their application to follow SBA's approach to which ones they're applying first. And so we're working on getting the calculators to feed into that. But, you know, the key for all of this is what math is happening off spreadsheet or in the supporting spreadsheets that feed into what payrolls in, which people are getting counted and which people are getting excluded.
Health insurance costs, self-funded insurance plan. I would, if again, no guidance on this, I would probably at the outset at least look at accruals. You know, what are you accruing on a monthly basis associated with that cost, and then find the 8-week equivalent. International warehouse, rent on it. I'm not certain that I've seen any. I know you can't have the employees and the wages have to be for U.S. employers. I'm not aware of any reason why you couldn't take the rent on an international warehouse, but I say that kind of as a question. I don't think I've seen that in any guidance, so I'm not aware of any reason why you couldn't do that.
I don't think there's a statutory limit on that,
yeah.
But we might circle back on that one.
Base period, February 15th to June 30th if an employee was full-time but left on May 31st, 2019. How are they counted? They count as, this is, you hit on a good example. So they were in the base period, they counted as an employee. Well, let's say they're 1 FTE. After the base period, but before February 15th, they left. Based upon the general rule, that is a reduction in FTEs that would punish you, but you would not have the ability to make it right because the reduction didn't happen after February 15th. I'm going to say this for the 86 people that are still here attending, and I didn't mention it during the presentation, but there is one other safe harbor, and it rarely comes into play, and this was not something in the act, but it is in the application. If there was not a reduction in FTEs from January 1st to any point in the year, then you don't have to worry about an FTE reduction. So if this hypothetical employee left in 2019 after the baseline, and you had no other FTE reduction after January 1 of 2020, you're okay. Now that's not in the code. That's not in any guidance. That is in the application. But again, so we'll treat it as such, even though, as Mark mentioned a bit earlier, the application is not authoritative.
All right, we got a group of questions on what the heck it's going to cost to comply with this whole thing, and that's we laugh, but that's something we're trying to figure out.
Yeah, I mean, I was trying to come up with and nothing is, that is something we're working on,
Those who are hanging on, hoping to have a concrete number, I'm sorry to disappoint you. We will not give you a concrete number on this call. The factors affecting it are going to be the extent to which payroll information can be sorted and summarized and spat out in the right format and with the right information to start with is going to be a big driver of it. And the extent to which there are gray areas or decision points on certain costs being in or out or partially counted or not partially counted will be another driver. But I think it's hitting on a concern that this thing looks and smells and tastes like a tax return. It's a pain to fill out, and having a group of people who work on dozens or hundreds of them has some efficiencies versus everyone doing one. Yeah. And so we're working through that and continue to look to Washington, because another part of it is, how valuable is it to get precise on some of these definitions? If I know that if they extend the payroll period to 16 weeks, then we're not going to hang on every possible thing that might be included in payroll costs or every possible thing that might tilt the 25-75 test, because they're going to give us enough runway that a lot more businesses will be at full forgiveness, and they'll just have to worry about the payroll data of FTEs and comp reductions. So some of the scope of work is still evolving, I think is a way to say it.
That's exactly right. And that's both from it's not only just the standard how do we break that down into specific situations, as far as the complexity on an individual business basis, as well as just the overall environment here is that we don't even know what the final rules are. I mean, we know what they are now, but there's still a lot that could potentially move that would impact the scope of this work. Would bonuses be included in forgivable payroll cost? Yes, again, subject to the limitations we mentioned. If an employee is chosen to take another job, you do not get harmed in your FTE count. And if they voluntarily resigned, you have no problem. This next question is an interesting one. To compensate employees relative to unemployment benefits and have it forgivable, is it a valid strategy to inflate some employees' hours to 40 hours a week and presumably inflate their pay associated with it? I think every situation is different. Without knowing your specific situation and crunching the numbers, my rule of thumb is what makes sense for the business. If it makes sense for the business to try to get those individuals off of unemployment and to inflate it, great. If you're just doing it because it's, because it's on the government dime, in other words, it's not coming out of your pocket associated with it, I would always be a little hesitant to pay an expense you otherwise would not pay merely because of the fact that it may be forgiven. Because there are expenses, there are additional payroll tax costs, for example, that are not forgivable that the employer is going to take associated with it. So again, if that's the right business decision for you to compensate those people at a higher rate, to get them back, from a non-PPP standpoint, then absolutely. And we'll do what we can to use that to maximize your PPP forgiveness, but make sure it's the right business decision for you.
Lori asks a good question on application due date. The banks have a statutory period within which to provide an opinion, a conclusion on forgiveness. There is no statutory timeline for making the application, probably because the assumption is that people are going to be antsy to get it in and get the answer to whether their loan is forgiven or not. So what I'm anticipating is that the banks are going to drive the timeline on a lot of this, with at what point they feel like they have enough guidance to opine on forgiveness on a particular loan, is going to drive the timing of when it gets submitted and reviewed and approved. So as I referenced, I think we calculated June 3rd is likely the earliest that anybody's eligible has completed their 8-week period. And that would be probably the first person in line to get funded. And lots of them are going to be coming up, second, third, fourth week of June. And so the way we anticipated the schedule working is that lots of people were going to be submitting their applications mid-June through mid-July, with decisions on loan forgiveness occurring over the month or two thereafter.
What is considered health insurance? I would say health, dental, vision. I think that those are all safe. After the okay, so this question from Robert is a good question. Calculations are made. You have an excess of $50,000 that's not forgiven. Will that be treated as a loan at 1%? That is correct. So anything not forgiven becomes a loan at 1% interest for 2 years. You can either pay that back immediately or, again, pay it back over that period of time. I think that last point is a good point, though. My opinion, and I'm curious to see if Mark agrees, the proceeds still have to be used for the appropriate things. They still have to be used for the eligible expenses, even if they're not forgiven. So payroll and all of those other costs. But again, it's not like we're tracking the specific dollar of loan to every specific expense. My guess is you would have enough payroll cost over the next 2 years or 1 year or whatever to utilize that $50,000 of funds and say, yes, we use these proceeds, even the loan portion, for eligible expenses.
I think that's it, Jeremy. I think for a business that remains a going concern, they're going to meet it. For a business that it gets the money but doesn't survive COVID, I think there could be some issues there. And I guess I'm not really that for a business that didn't survive COVID. I'm not sure what the SBA is going to do to smack your hand if what you've done is have $50,000 of excess costs and you pay it back to the bank. Maybe it didn't fit within the technical definition of the statute, and maybe there are some potential penalties for taking out the loan and not using it on the right things. But I don't know how they're going to squeeze blood out of a turnip on that. So, but for a business that's a going concern, I guess our assumption is that whatever scraps are left are going to get spent on payroll or non-payroll good cost over the next 2 years.
Yeah. The loan forgiveness application, when do we have to do that? So Mark covered that. The application, SBA should have that on their site. What I will do, Jen and Sean, let's go ahead and upload a copy if we don't have one as well. We'll make sure we have a copy of the loan application on our website. The next question about the rehire, so you reached out to rehire somebody during the covered period. They never got back with us. I would do everything you can to document that you tried. And barring further guidance, I would try, if it makes a difference, I would try to classify that as a rejected rehire offer. But again, I think be very clear about what you did to try to track them down to make that offer. Again, I think it's a little bit of a gray area, but do what you can to document that process behind it.
And with all of this, you're going to rough in some of the answers to these questions, and some of them, when you run the math, aren't going to make a bit of difference. So, if you got back to your February 15th FTE count either way, then by June 30th, then we're not going to care it. Then I think you can be a little bit more aggressive in how you answer that question, knowing there's a safety net that gets you to the exact same spot, even if that determination turns out to be questioned later.
Yeah. Are we allowed to submit our forgiveness? When are we? Again, there's no statutory guidance on when you have to. But again, if it's going to take you until June 30th, which that's part of the question, to meet the rehire qualifications, and that makes a difference, then I would wait till after June 30th to do the application so that you can state and certify that you have corrected the deficiencies either in wages or employees.
I think that's exactly right. And I probably accelerated the timeline in what I just ran through, because if you think about a business that's 8-week period runs out mid-June, they're going to have a cell phone bill that they're not going to get until July that covers June activity. And so, a lot of this I think is likely to be more of a July and August exercise anyway.
This next question I want to take because I feel bad. Tom is still here. You made it sound like in your last comments that loan forgiveness is either all or nothing. I was under the impression you could still get the amount that qualified forgiven, but anything over either need to be repaid or taken as a loan. That is exactly correct. So I apologize if probably me, if in any way misstated that. My comment was there is a lot of bad information, as you just pointed out there, that gives people the impression that it's all or nothing. Rarely is anything you do going to be a cliff as it relates to this forgiveness. If you're paying the right cost and you're paying some amount of people, you're going to get some amount of forgiveness. So I entirely agree with you that it's generally not an all or nothing. The only time it's going to be all or nothing is if SBA comes in and examines you and says you did not meet the certification requirements, then all of it is going to be a loan. Short of a drastic situation like that, you are exactly right. None of the things we really talked about today gets you to a zero forgiveness situation as long as you're paying some salaries during the 8 weeks.
All right, next question's on triple net CAM recoveries. There's going to be this basket of bundled costs under some leases where there's utilities or other potential good costs mixed in, and I think the reasonableness rule is gonna prevail here. If you can show that you pay a lump sum for something and it's composed of good costs and bad costs, and you've made a reasonable effort to isolate the good costs, then I think they're good costs. And if you're struggling to strip out the good from the bad, then some reasonable proration or treating them all as bad costs seems to be the way forward.
Next question, does cash basis on front end and accrual at end also apply to non-payroll cost? Yes, that is correct.
Yeah, the one is based on the next payroll and the other is based on the next billing date of where that utility or other non-payroll good cost would otherwise be paid.
Yeah, renewal of a copier lease, that's the next question. I think we've covered that. Yes, renewal of an existing lease prior to February 15th. I think that's a good, if it's material, if it's the same equipment, for example, then I think you're fine.
Yeah, Jeremy, the upgrade situations may be a little stickier.
Yeah, you notice I qualified and was going to leave it at that, but I agree.
Sorry.
I think you're exactly right. I think that's a little less clear. Payroll ending in the middle of the 56-day period. I'm paying out wages already within the 56-day period that we have accrued. Do I still get to count the pay period that ends in the middle of the 56-day period? Yeah. Anything that's paid within the 56 days and anything accrued at the end of it that's paid on the next payroll, all of that counts. Pay out a bonus. Yes, bonuses are good. Again, you just got to be aware of the $15,000 limit, but bonuses and hazard pay, doesn't matter what you call it, it counts. But pay it during the 8 weeks.
And again, Michael asked on people trying to sneak in an extra payroll, yes. And we thought we might need to do this, but on existing guidance, we don't. We don't have to sneak it in.
Yeah, sorry, Mark, I didn't mean to interrupt.
Nope.
The documentation for self-employed is going to be you produce a 2019 Schedule F or Schedule C. And there's no other calculation that really, there's nothing else you need to show related to that.
Right. If you're a self-employed physician, for example, and you got 2.5 times your average monthly, let's say you made more than $100,000, so you got a loan for somewhere around 20 grand, you're only going to get about 15 and change of it forgiven, and you're gonna send in your 2019 Schedule C showing that you made more than $100,000, and that your compliance cost for this is going to be one of the lowest of anybody.
That's exactly right. Jamie's question's a good one, and I hope that nobody had asked this question. No, I'm kind of only kidding, partially kidding. So salary wage reduction analysis. Let's say a borrower did reduce an hourly pay rate, but not the employee's number of hours worked. Are they going to use rate times hours as basis for the calc of total wages, or are they performing the 25% reduction analysis based on rate only? Okay, so that I do feel, I think, pretty good about that. I thought maybe the question was going elsewhere. It is, you're looking at hourly rates. That's my understanding. Is the hourly rate more, is a reduction in the hourly rate more than 25%? And if so, you multiply that by, I believe, average number of hours during the 8-week period to get your reduction. I think that's a great point. I think that mechanically you could get a situation where somebody's hourly rate was was reduced by more than 25%, but at 40 hours a week for the 8 weeks, they never got below 25% of their what it was for quarter one. But I believe it's meant to be on a rate by rate, a comparison of rates between the two periods.
Yeah, that's, Jeremy, I think that's one of those things that you wish you'd have a 100% ironclad answer on at this point in the game. The application uses the word hourly wage, which I think most people would look at that as the hourly wage is the wage per hour, which is the interpretation that you just proffered. If you put a gun to my head and said, well, is hourly wage hours times rate gave me my hourly wages? Maybe. So
if it's beneficial and we don't have guidance, maybe we give it a shot. Yeah, again, we haven't seen a specific date when everything is absolutely, we haven't seen a drop dead date on the application either, to Sue's question.
Yeah, so the date it's due, sometime in the fall. So there's a few dates floating around out there. One is the stated expiration date of the form. The forgiveness form is October 31st of 2020. So I'm guessing that math to get there, let's see, would be that July and August would be kind of the filing season, and that banks would then have September and October to conclude. But I think there's going to be people anxious to file before they're able to file based on collection of all their good costs and adding back the amounts incurred and not paid at the end of the 8-week period. And I guess knowing the way this program's rolled out and knowing that Congress is still considering tinkering with it, it seems entirely plausible that we're a ways away yet from it seems likely that this form might need to change, I guess would be a way to say, which would throw a monkey wrench into everything.
Employer paid FICA, Medicare, Social Security tax. Yeah, those employer portions do not count towards good cost. Those are not payroll cost or compensation. General liability and workers' comp, allowable for non-payroll good cost. No, those would not be included. No income draws on the S-Corp question. So you include their W-2 wages subject to the 2019 limitations we talked about. Owner draws for an S-Corp owner do not count. Annual software leases included, its leases on real or personal property. I would probably
so I think
What's that?
Well, I think we get down to what's personal property, and can you make an argument that it's intangible personal property as well as tangible, and there is no modifier to say whether it's intangible or not. So I think there's an argument.
Yeah, I would try to take it. Yeah, I agree. I don't think we can say that with 100% certainty, but I agree. Elisa, since auto fuel in business vehicles is included in the utility category, what about diesel fuel expenses incurred by a trucking company? I don't know. I don't see any reason why not, Mark. Do you?
I agree with you. I'm not there's a nuance here I'm not picking up on, I think. I think that's automotive fuel, whether it's whether that's their core business or whether they or whether the fuel cost is ancillary for equipment used for other purposes. I think it's utility.
Yeah, and maybe that was the nuance I was missing, because that was the same problem I was having. I didn't see it being problematic, but I was afraid I might be missing something related to that. So yeah, I would include it.
Another question on sales phones.
Yes.
Yeah.
This is another lease agreement question. So you lease tangible property every year. The lease agreements are not signed until April. If these are continuations of, leases associated with the same personal property, I think I'd be okay with it. I might need a little bit more information on that, but I think if it's a 1-year lease that you renew every year and it's associated with the same personal property, I don't have any heartburn related to that.
Let me look. I think most of our bankers have dropped off the call now, so we'll just throw them under the bus. I think this goes back to, unfortunately, Congress has put the banking industry in the spot of being the final arbiter on some of these gray area decisions. And what I would advocate is putting a memo for these types of items, if it's material, including with the application, a memo explaining the situation and the business transaction that gave rise to it, and the extent to which it's a continuation of a lease that's long established and has the anticipation of being renewed on an annual basis, and trying to go at it that way. And the worst thing that's going to happen is the banker's going to say, nope, I can't sign off on that.
Yeah. All right, we're down to 15 questions. We still have 64 people attending. Those of you guys are amazing that are still here. So let's run through these, and I think some of these are duplicates. Lawn care does not count as a good cost in any way. Employer taxes, yeah, and I've probably confused the issue. I thought FICA was excluded, but an answer to an attendee says it was included. Yeah, we've got to be clear about what type of FICA taxes we're talking about. Gross wages to an employer, and gross wages to an employee, count. And so you do not reduce employee wages by the amount of FICA that they have withheld. But employer payroll taxes do not count. You do not get to add employer taxes on top of those. Okay, so that's where there's a difference. So the employee portion is included in gross wages, employer portion of payroll taxes never included. PPP loan, is that federal funding? Ooh, this is probably related to a regulatory issue that I'm unaware of, and I don't want to step in a minefield here.
Maybe.
Yeah, I would say
that's what I can do on that one.
It could be. Yeah, we can follow up. Talk to your advisor, and we'll follow up on that question. Send us a message about the specifics, and we can go into that further. Transportation fee, we're interpreting that based upon the indirect guidance we've received to be fuel associated with vehicles used in the business. So it's not really a transportation. They list transportation as a utility. That's what they mean, gas or fuel used to operate a vehicle.
Right. I think our overarching guidance there is that it's under the category of utility. And so how bold you are in including costs that you wouldn't rightfully call a utility, I think is going to be where the line is on that.
Workers' comp insurance, I'm not aware that would count. I don't think, Mark, right? That's not included in that broad definition. Comp. Let's look.
Employees who retired from a prior job, they've worked for us part-time. for a few years or more. Is their payroll forgivable? So any of your employees that work in the United States are going to be part of your good payroll costs. So general rule is the starting point is yes, subject to all the other limitations that we ran through. Next question from Michael is he thinks that January 1 through February 29 of 2020 will be his base period for measuring FTEs. He uses this only for FTEs to compare to the loan time frame, which is April and the 8 weeks from April to May, and use the comparable loan time in 2019 for pay level. So I think what he's getting at here is, am I right that even though I'm using January and February for FTEs, that I have a different base period for calculating the 25% pay reduction? And the answer is yes. That one is based on Q1 2020 and the other is this 2-month period.
Yeah, that's the only correction to that is the FTE period is, like he says, January to February. The pay is January, February, March of 2020, not 2019.
Yes, I'm sorry. Yes.
Kimberly says we've done an outstanding job. I just wanted to get that on the record. Thank you, Kimberly, for that. Long-term disability, the company pays 100% of the premiums to employees.
Yeah, I think long-term disability, long-term care, life insurance, those are all those fringe type benefits that don't fit neatly under health. I think they're out.
People that are out on leave but have not officially quit.
I think we may need some more facts on what the leave is related to, but paid. I certainly think that paid leave, they're going to count in both your wage number and your FTE number. Unpaid leaves of absence, I think are stripped out of both. Thoughts, Jeremy?
I think that's right. I mean, I think if you're, I don't see how you get hurt on an FTE calc because they're still employed. And that's one of those, even if they're not working any out, I mean, I would treat it that way. I don't think I would take a reduction for leave. I think that's one of those exceptions we can fall under. The wage piece of it, yeah, I don't know, but it seems to me if somebody's on leave and not being paid, to me, that's a reduction in pay that's associated with a reduction in work. So I don't think you get hit on the wage side either.
Right.
So I think we're saying the same thing on
and
that.
It could be voluntary, right?
Yeah.
Yeah. Okay. Likelihood of having 100% forgivable loan. In some industries, very, very high, and other industries, very, very low, I think is the answer to that question.
Between 0 and 100%, that's a crappy answer, I realize, but anyway, sorry.
We have quite a few people, quite a few clients that I'm very certain will get to 100% loan forgiveness. We have quite a few that I would say are likely in the 80 to 100% range. And then we have a few that were most impacted by COVID. I guess that's the cruel fact of it.
Yeah.
Is that the harder you were hit by COVID, the less likely you are to get to full forgiveness. I know that our restaurant clients were extremely adversely affected and faced the challenge of competing with the unemployment system to hire people back. And that sets up for a very difficult fact. And that's a big driver of why Congress and the current administration is considering and actively pushing in some cases to extend the covered period from 8 weeks to something longer to give those businesses that were shut down for long periods of time the ability to put these funds to productive use. Do you want to read the next one into the record, Jeremy?
We can, that's fine. I thought maybe I wouldn't this time. Anyway,
all right.
Okay. Sherry says we rock. Thank you so much for the webinar. Thank you, Sherry. Seriously, thank you for your participation. Thank you for everyone who participated and asked questions. These are fantastic questions. Yeah, so no, I appreciate all of you guys that have hung with us through this. have really enjoyed it. So final 4 questions.
All right, we have monthly payroll. They got funded on April 20th, and they're trying to figure out whether the payroll that they will receive on June 30th is in or out. And the answer is the first payroll after April 20th is all the way in.
Yes.
The June 30th payroll is going to be partly in and partly out. There's going to be a proration based on the amount that was accrued and unpaid on I can't do the math in my head, whatever the last day in the 56-day period was after April 20th.
Right. Hourly rates weren't reduced, but hourly employees had overtime in quarter 1. This is one of those unfortunate areas where it's unknown. I would say that barring further guidance, I would try to make the argument it's based upon base pay and that overtime doesn't cloud that, because you're still paying them the same general base hourly rate that you were before. You shouldn't be penalized for that.
Can wages and bonuses be used to make up for shortcomings in payroll costs? Yes. Bonuses and wages are good costs. Our recommendation is that they get paid within the 56 days. Don't rely on accrual.
Right. Employees, we give them an internet and cell phone payment on the first check of each month. And say if it's included in payroll, that's a pretty broad compensation. I think if they include it as W-2 wages, I would include it. Mark?
Yeah, I think that's exactly right. And it goes back to our accountable plan comment before. If the internet and cell phone payment is subject to an accountable plan excluded from wages, then you're counting it as utilities. And if it's included in wages, then it's already in your gross pay. Don't add it to utilities because you've already got it in your wage number.
Yeah.
All right, with that, we have answered all 158 questions, taking just over an hour and a half extra time. Thank you to the marathon runners who stuck with us, 49 of them for the entire session. And we will be pleased to post this in multiple parts, one with just the core presentation, the other with question and answer, and the last with the combined almost 3-hour file for future consumption and to compare about and to give us the opportunity to reflect back when Congress or somebody changes the rules here over the next 3 weeks to know how wrong or right we were based on what we knew today.
Yeah, I think that's well said. We will continue. We appreciate you guys, everything you guys are going through. Thoughts with everybody. Hopefully we're turning a corner, but as we continue to get more information, we'll continue to communicate it in whatever, format makes sense, whether it's email alerts or, again, if we do get additional guidance that warrants another webinar, we'll be here. So thanks guys for participating today.